Okay, good morning. I'm Scott Gray, the local president of the Air Force Association West Coast chapter of Florida, and on behalf of the AFA, I'd like to welcome you to part 3 today of our Ukraine 1 year later. Today, we're going to just be looking at food, famine, energy, plus the effects of the war on the central bank policy and financial markets. Looking forward to lively discussions, to say the least. We've got some tremendous panelists for you today and speakers. I want to say thank you to Dr. Holbrook and the University of South Florida Sarasota Manatee campus for sponsoring this and being one of our collaborators. The other is a Global Interdependence Council, and I just want to say thank you to us on Global Interdependence Center, and I want to say thank you to David Kotok for being one of our cohorts and making this a possibility. Really looking forward to moving forward today and following up on yesterday's discussions where we focused on bonds and stocks and the impact that the war's had on those. So without further ado, let me turn this over to David Kotok so he can start moving us along with today's agenda. David?
Thank you very much, Scott. Just so that participants know where we are in this extensive series that has evolved since the early part of February. Today is the final day that will focus on the Russo-Ukraine war and direct outcomes from it. On April 20th, we will move into payments. We discussed some of the issues with payments yesterday, but we will move on April 20th into cryptocurrencies, central bank digital currencies, more into the finance and payments section on April 20th, and we now have a confirmed speaker who will be in person in this auditorium, and that is Federal Reserve Governor Christopher Waller. We've confirmed his attendance. He will deliver a keynote speech late that morning. We are changing the format so that we want the auditorium to be open. Anyone who wants to register and visit in person will be welcome the morning of the 20th and the 21st. It also appears that our second day, April 21st, which is going to focus not on the Russo-Ukraine war, but on how it's had impacts in China, in Asia, will include a substantial military briefing. Scott can say a word or two about that speaker later this morning, and a discussion of geopolitical risk and policy, which will include Kevin Rudd, the former Prime Minister of Australia and now Ambassador from Australia to the United States, and Jonathan Ward, who is an advisor on China policy to the Pentagon. And he's got a new book. He'll be here in person. Hat tip and thank you to Kelly Caldwell and Caldwell Trust for sponsoring him. And there will be a full-blown panel discussing China. It'll include Michael Drury and Lee Miller and others from the Global Interdependence Center. So April 20th, payments, cryptocurrencies, central bank digital currencies, monetary policy issues. I will do a fireside chat interview with Governor Waller. And April 21st, China, Asia in multi-dimensions. That's the changes in the schedule. The in-person attendance in the auditorium is welcome. Of course, the virtual audience will be large for that lineup, but we are opening the auditorium so that people in the Sarasota area are welcome to come sit in the TV studio and watch the show. Today, we're going to talk about food. big issue, huge, stellar lineup on this coming panel. The implications of moving hundreds of millions of people who are experiencing Putin's famine worldwide. And we're going to talk about oil and energy in another panel discussion. All the folks who are on this conversation are supporting of this dialogue, and they're loaded with facts. Then we get to central banking. We have two central bankers in a session and moderated by Michael McKee of Bloomberg Television. And we have a special last program. Joe Mason, an expert in banking, in liabilities, a nationally prominent expert as a witness in litigation, a professor, and a personal friend, has agreed and moved his schedule around so that he can talk about the banking crisis and what's happening with Silicon Valley Bank and others in the United States. All that's coming today. So without further ado, let's get started. And Kelly, will you take it from here? Thank you.
Okay. Good morning, everyone. This is Bill Kennedy from RiskBridge Advisors, also the chair of the Global Interdependence Center. Very happy to be back with you today. To David's point, we have an all-star panel to present on food insecurity, and famine, and all things interrelated to the war in Ukraine's impact on agriculture. So joining me today on the panel, we have Dr. Seth Meyer. He is the chief economist of the USDA. His second tour of duty at the USDA. Prior to this, Seth was a research professor and associate director of the Food and Agricultural Policy Institute at the University of Missouri. Also joining is Dr. John Newton. John has been with the GIC a few times over the last couple of years. John, welcome back. He's the chief economist at the U.S. Senate Committee on Agriculture, Nutrition, and Forestry. And our friend Brandon Zick. Brandon is the chief investment officer at Ceres Partners. Ceres is a private equity firm specializing in farmland and agriculture and natural resources, and really a great panel of three experts who I think will share some tremendous insights. So I'm going to kick us off with a speed round. I'm going to go back in reverse order. Gentlemen, I'd like for you to share with the audience in just 60 seconds or less, what's the one thing that you have discovered in your research, or one factoid that our audience members may not know as a result of what's happened in Ukraine and its impact on agriculture? Just that one thing, and then we'll come back around for the discussion. But Brandon, why don't I start with you? Maybe you can kick us off. What's the one thing based on your research that you found so fascinating?
Yeah, thanks, Bill. I think to start off, when I think about what's going on in the Ukraine, uncertainty is really the tagline I hear over and over, and not just uncertainty of today, what it means for 2023 grain production and food availability in the world, but really as we think 2, 3, 10, 20 years out, what it means. So I think we hope that the conflict in the Ukraine is resolved in short order, but the reverberations that are going to exist within the global ag structure for quite some time, I think, are going to be very meaningful, and a lot of folks probably underestimate what that could be.
Great. Thank you, Brendan. John Newton, over to you.
Well, so we had a meeting this week with all the Republicans on the GOP side, and one of the things that came up, Senator Rubio brought up food security issues, and I think as we approach the Farm Bill, we reauthorize the Farm Bill every 5 years. There's going to be a renewed emphasis on domestic food security here in the United States. There's already conversation on foreign land ownership in the United States, or foreign ownership of our agribusiness companies. So our current Farm Bill expires in September of 2023. And again, I think as we approach reauthorization of that, we're going to have some hearings here on Capitol Hill about some of these very important issues as they pertain to food security.
Thank you, John. Seth.
Yes, for me, I think it is the uncertainty, but one of the contrasts that I found is, and I think it was pervasive through your introduction, is a lot of other industries and other sectors are dealing with uncertainty. In ag, we're kind of used to uncertainty as it relates to weather. The war is quite different, but when one thinks about the supply chains for corn versus the supply chains for cobalt, those are two very different things. So while we are used to uncertainty, I think the war has brought a different kind of uncertainty to us in global agriculture. And I guess the other surprise, I think if you'd asked me 1 year ago, the Black Sea Grain Initiative worked better than I would have expected, perhaps not as much as it could, but that also surprised me that initiative at least appears to be continuing on and is an important element for both Ukraine and for global grain markets.
So Seth, let's stick on that for just 1 second. The Black Sea grain deal. This was a UN plan that was hatched last year, I believe. Can you just inform our audience, educate us on the background of that deal, how it came about, and what the impact has been from your perspective?
So I think the deal comes about, and again, I think you think about Russia and Ukraine and initial elements, initial concerns and volatility in these grain markets at the start of the war, uncertainty about if grain can be transited, whether that transition of grain out of the region comes at a high security cost, and that these grains are important to moderate volatility in global markets. Turkey playing an important role in this as kind of the intermediary to bring those grains through the Black Sea and out into the global market. So you have a 120-day renewal of agreements about moving grains and oilseeds out of 3 Black Sea ports within Ukraine. Not all the ports, they have more ports than that, some of them which were doing multiple $1 billion worth of business before that. But this is really a UN brokered agreement between Russia, Ukraine, and Turkey to move grain out of Ukraine 3 ports, and also an understanding that food and fertilizers don't face sanctions out of Russia.
Terrific. Thank you. John, any perspective or insight on that deal or how it's perceived on Capitol Hill?
Well, farmers have long, as Seth indicated, farmers have long been used to Mother Nature being their business partner, but now they have to contend with geopolitical risk. It started when trade was weaponized with China, and that's how I first met David Kotok when he reached out about soybeans in China and the potential phase 1 agreement. But, the last 2 years, we've seen farm production expenses, the inflation in fertilizer costs and energy, diesel prices, has driven farm production expenses to record highs. And so this is going to be the most expensive crop that farmers have ever grown in this country. If they're raising livestock, those expenses are extremely high as well. But we're also starting to see grain prices soften. I know Seth follows this pretty closely. Managed money in the corn market, for example, is now in a negative position for the first time since August of 2020. That's putting downward pressure on grain prices. The high interest rate environment that we're in to offset inflation is also hurting farmers as they take out massive operating loans, again, to put the spring crop in the ground. So, again, not only are we contending with Mother Nature to raise our food supply, but we also have these geopolitical risks that likely are not going to subside anytime soon.
So I think it's an important message that what the food production cycle is experiencing around the world is more than just the weather cycle, right? This is war, and all of the grotesque negative elements that come with that. Brandon, you shared with me just a couple of factoids around what's been destroyed in Ukraine during the last year. Can you just maybe share with the audience a little bit about what's happened with commodities, implementation, farm equipment, farmland itself, based on your research?
Yeah, I think that's what, as we think longer term, how will global grain production be affected? It's not just the commodities that were stolen, that were billions of dollars of commodities that the Russians took, but the close to 100,000 pieces of farm equipment that were destroyed that are not easily replaced. And then the soil degradation that's happening in battlefields from unexploded munitions. I mean, we can look back at the Battle of Verdun in World War I, and those soils have never been able to be used again. So there is definitely land that's going to come out of production for quite some time, and so I think that's kind of shocking when you think about the farmland we have here in the United States and how fertile and easily accessible it is to have similar type ground no longer be able to be used, and that could go on for quite some time. So I think there's those numbers continue to grow, and it doesn't even take into account the farm operators in the Ukraine that have had to go to war, and some that will not come back. The skill set that's disappearing from that region as well is something that we're going to see the after effects of for a number of years.
Bill, can I add something to that?
Yeah, please, John.
Very early on in the war, Senator Bozeman made a number of comments. We have millions of acres of productive cropland in land retirement programs here in the United States. The Conservation Reserve Program allows farmers to retire not only environmentally sensitive cropland, but productive cropland for 10 or 15 years. And we petitioned for Secretary Vilsack to let farmers exit those CRP contracts so that they could respond to the lost production that we're seeing around the world. And ultimately, we were successful. There were about 2 million acres that were coming out of the CRP program last year that the secretary did allow farmers access to that ground without penalty after the primary nesting season, which again allowed farmers to get in and start preparing the land for fall crops that they may have planted. I think the Europeans did something very similar, Seth, and letting some of that fallow ground come back into production.
Yeah, and I think that's part of, I think, looking at this at a global scale, I think some of these responses and flexibilities are important to note as well, too. And maybe we'll get to that. But from a broader sense, one of the other jobs that I have besides chief economist is I chair for the US for Amos. And what it is kind of points out that some of these export controls that countries have thrown on or trade impediments tend to make this volatility worse in these types of situations. And it's, again, we're introducing uncertainty beyond weather, but we see folks throwing in export controls, and that only transmits volatility to the most vulnerable consumers around the world. And so you got to keep those chains of trade open.
Yeah, Bill, I'd like to follow up on that. Just to Seth's point, export controls, particularly in the U.S., are difficult because we are in, at least on the ag side, we're an export-based nation, and it makes no sense to do that. It's essentially, we've seen it in other sectors, it's a run on the bank when you do things like that. The system doesn't work if you don't allow farmers to export, if you don't allow us to trade with the partners we have out there with the most efficient trade routes. So, we're a big fan of just keeping global trade open and not acting too quickly to try to impose restrictions that, frankly, a lot of folks just don't understand the repercussions of what those restrictions ultimately result in.
So that gets into the entire theme of the interdependencies that exist around the world, different countries, different policymakers. Could the three of you address how is global agricultural policy made? Seth, you mentioned Amos, and could you explain to us what Amos is, and just take us inside a room and what type of conversations and discussions take place to try to reach coordinated, collaborative agricultural policy worldwide?
So I don't know that I think its primary goal is merely information, so that you don't have reactionary, poorly thought out policy responses which shut down exports from other countries. In the US, we don't do that because, as mentioned, we're exporters. I think we also, our producers have a sense of, hey, a sense of pride of feeding the world as well, too. We're a responsible participant in global grain markets, and that's what helps moderate that volatility. So when I think about Amos, it's mostly a very narrow prospect of saying, don't do bad policy, and here's information and what's going on in the market. Let's keep a cool head. let's keep a cool head. There's grain, but we are interdependent. Grain moves around. When I hear the Russians, for instance, say, hey, this grain deal isn't necessarily working for us because the Ukrainians are sending their corn to Spain. It's the fact that that grain is on the global market, right? It's the fact that it's on the global market that adds to supplies and tempers prices. The wheat going to Turkey doesn't stay in Turkey. It gets milled and gets sent to places like Yemen, some of the most vulnerable consumers. So these are complicated markets. And I think from a policy standpoint, Amos's goal is let's not be reactionary. Let's think through these things and not exacerbate volatility.
John, from a policy and coordination standpoint?
Well, I'll tell you one thing that's probably missing from the conversation is the acceptance of science-based practices around the world. And I'll give you a great example of that. Mexico's decree to ban GM corn from the United States is not based on sound science at all. It's a slippery slope that could impact other trade routes around the world, other commodities around the world, and it's penetrated deep into Africa. It prevents us from moving a lot of product into those countries. So we need to make sure that trade is science-based. If we negotiate trade agreements, we need to make sure that our trading partners live up to the promises that they made in those trade agreements. So that's critically important. And then, for sustainability and conservation, folks around the world want to see more cover crops, but then they don't want to accept that farmers have to use herbicides to terminate those cover crops. Folks don't want to accept GM crops, but then we want to be productive and feed the world. We're producing 3 times as much crops and livestock today as we did 50 years ago while using the same amount of inputs. And that's because of investments in machinery, seed technology, things of that nature. Again, so we need to accept science if we're going to feed a hungry world.
Thank you, John. Brandon.
Yeah, and to just follow up on John's point, I think the production that we have today using the same amount of inputs is also being done with significantly less land. So land is becoming more productive. Farmers are generally some of the best stewards of land that are out there because this is not a 5-year or a 10-year asset. This is a multi-generational asset that needs to be maintained and sustained. And I think any part of discussions about food or famine that don't involve that science-based approach to actually look at how do you maximize production with limited inputs is really a fool's errand to do that.
So I'd like to talk about prices and inflation. And I think we could take this a number of different ways. Brandon, I'm going to start with you. And I'd like to focus on those long multi-generational assets, right? What's happening with the price of farmland in the United States? And then if we have any perspective on what's happening with the same in other major production areas. Can you just speak to what's happening with land price, agricultural price?
Yeah, land prices have been strong. That's our business, is trying to buy farmland and rent it to local farmers. And it's been difficult to deploy capital over the last year, just given the strength in pricing. That has, from our observation, at least in the Eastern Corn Belt and the Great Lakes states where we have a large presence, that's been driven primarily by farmers. When we go to farm auctions, it's typically neighboring farmers that are buying farms for prices well above what we could, as an investor, could pay in cash flow. But there's also pressure from the greater success in the U.S. economy, so industrial development, commercial development that's happened, that typically takes farmland out of production. And we haven't, from a farmland standpoint, maybe the pricing is plateauing, but it's certainly not coming down, which is a little bit of a head scratcher given that General Gray and I were talking about what was surprising from last year to this year, and grain prices have come down significantly while input prices have remained pretty high. So that means profitability's come down for the farmer, and you would expect, if there wasn't such a backlog of demand for land in the system, that prices would have come down. But it's clear that, at least for some time now, there's going to continue to be demand for land, whether it's from farmers trying to grow their operation, neighbors adding on to existing parcels, investors like myself who are looking to add ground in our portfolio. But I think prices are going to remain strong. And as you think globally, I know less about those regions, but certainly in Europe, prices have always been high because of tax policy that kind of favors land ownership, and I don't think that's changed.
Can I add one element to that, Bill? One factor that's influencing the capacity for farmers to continue to bid those land prices higher is since 2018 through this year, $93 billion in ad hoc support has been delivered to the ag sector, whether it was through market facilitation program payments during the trade war, coronavirus food assistance payments during the pandemic, the Paycheck Protection Program, and then we've had 6 years of ad hoc disaster aid to help farmers recover from hurricanes or derechos, whatever the natural disaster may have been. 70 billion of that came from outside the farm bill. So farmers have a lot of cash on hand to purchase these assets. Now that's diminishing now as these grain prices are lower and the federal support to agriculture is diminished. So that upward pressure on land, as you said, is plateauing, and I think that reflects the working capital that farmers have is starting to slow down a little bit.
Seth, any perspective?
I think only you got two experts here talking about domestic, and I'm not an expert on global land prices, but I think each location globally is going to be quite different. And I kind of think about this in terms of Brazil's got an opportunity to continue to double crop. There's land left in Mato Grosso that's developable. It's depleted pasture. There's some land which can come in there. And then I remind everybody that, one of the linkages here about land prices is the connection between commodity prices and land prices is pretty good in the U.S. And I'll remind you that in Ukraine right now, when we talk about what's the price you could get for your grain at port, the farmers there aren't getting anywhere near that. It depends on the infrastructure in order to get things to port. And so one advantage we have in the U.S. is pretty good infrastructure to get things to port, an infrastructure that we need to maintain. You see the Brazilians developing that rather rapidly, and that's also part of why you see area expansion there. And then when you think about Ukraine, yeah, the port's not that far away, but it's not exactly an easy condition to get that grain from inland out to the port. And so whatever the port's offering you, you got what we call basis, what the farmer's getting has to adjust for that price wedge. So I think there's a lot of difference here about how I see land around the world.
We saw that here. Last year you could walk across the Mississippi. If you could walk across the Mississippi, you can't move grain, and cash prices fell as a result.
That's a good point, John. The drought conditions that we saw along that major waterway had a real impact. Let's turn then to food inflation, and maybe just to set the table, no pun intended, to the U.S. Seth, USDA is expert and does a lot of tracking of food inflation. Can you explain what's the difference between food at home and food outside? Which one's bigger? What's more important in the calculation of CPI for food? Can you just kind of give us 101 in how that works?
Yeah, no, it's a great question because it's almost impossible to answer over the last couple of years. So I can't be wrong to some extent, right? Okay. So I think if one went back in history and pre-pandemic and tradition, you'd see, food at home is, and I'm going to talk really broadly here. Folks that know all the details will argue with these very broad discussions. Food at home is just what it sounds like. I'm going to the grocery store, we're sitting down, we're cooking a meal, and those expenses associated with that. Food away from home, we're going to go out, we're going to sit at a restaurant, and we're going to eat together. Okay, so one can think about, hey, the actual food portion of that difference is different because it's more at a grocery store. When I'm out at a restaurant, I'm also paying for atmosphere. I'm paying for service and paying for some other things. Historically, that food away from home had been growing, folks eating out a little more. I'm an old guy, so we didn't eat out very often. That's not the case anymore. People like to go out to eat. When we come along to the pandemic, you have a big shock. You cannot go out to a restaurant. Most of the restaurants are open. People either don't want to or cannot. You see some of those dollars then refocused on grocery stores. And we observed some things like meat demand being quite strong quite strong. And so now when we think about this transition again, we're kind of moving back to pre-pandemic food away from home, a little more eating out, a little bit more dining out. But these have been definitely shocks to the system. Add shocks to the system, our usual weather stuff, and then add other issues of animal diseases or supply chain disruptions or other factors all contribute to this as well.
Got it. And tell us historically, food prices in the United States on average, kind of around the 2-3%?
Yeah, I think so. If we go back pre-pandemic, you'd say we were approaching, and I'm talking really broadly here, 50-50 split between food at home, food away from home, and about a 2% annual growth rate in inflation. Somewhere in that, around 2%.
And what have we seen in the last year or two as spikes have come in? Obviously, everyone's complaining about eggs, obviously, but in general, what has happened with that 2%?
We've had much stronger rates through the end of last year. Because of base effects, maybe we see some of those rates starting to moderate, still above what we've observed for the last several decades in terms of inflation rates. So, still, even as they are coming down, still rates we need to keep an eye on because they're above what we've observed. We had very stable and low inflation rates. You kind of got to go back to the 70s and early 80s to see the levels of food price inflation that we're experiencing.
John or Brandon, anything to add to that? From a food price inflation perspective?
From a policy perspective, what the inflation in food prices has done is we're now projected to spend $1.2 trillion on our SNAP program. And that's something that's, authorized in the Farm Bill. There are 41 million people in the United States that receive SNAP benefits. The average benefit per person is over $230 per person. And again, some of that's driven by food price inflation. Some of it's driven by some changes in policy. But that's going to make, moving the next farm bill, which is something I'm very focused on, pretty difficult when a farm bill is $1.5 trillion and 60% higher than the last time we did a farm bill. And, the House is focused on the debt ceiling and reducing our deficit. It gets pretty challenging to pass this critical bill that addresses, the risk management tools that farmers need, as well as the food security tools that our population depends on.
And John, I would be a big proponent of changing the name of that from the farm bill to a food bill at some point, because the farm aspect is a small portion of what we're talking about. But when you think globally about food inflation, in the U.S., we are blessed with the fact that a very small percentage of our disposable income goes to food. When you look at some of these other nations, developing nations, that you see 30, 40, 50% of their disposable income is used to eat, then that food inflation really can whipsaw pretty quickly. And I think that's where, when we talk about food and famine globally, that's where it's really coming in, is how's it going to impact those developing nations and their ability to feed their people.
And I think broadening that out is important, right? When I think about the U.S., about 16% of your food, about 16 cents on the dollar of your food price expenditures is before the farm gate. Most of it's after the farm gate. That's not true for many developing countries, right? They're much closer to that volatility in the commodities markets. And I think at the risk of talking to folks who know this more than I do, the dollar strength now is not something we saw in the last food price spike either. The dollar is much stronger. So when we think about the most vulnerable global consumers buying commodities priced in dollars, the high dollar has an additional effect on them right now, the strength in the dollar. And again, they're much closer to that volatility when you think about core vegetable oil prices or core wheat prices, or they're much closer tied to that volatility than we are here in the United States.
And any of the three of you, just take us around the global map. Where are the pockets of stress from a food security, famine, closer to that commodity volatility that you talked about? Can you just kind of help us by region or country?
Yeah, so by region, obviously there'll be a lot of countries in North Africa in general, places like Yemen, folks spending an inordinate amount of their income on some basic staples, to the point that even though maybe flour prices in Yemen have risen, they actually are spending more on wheat flour because they can't afford anything else. So you get some kind of very strange responses. So any country that is import dependent is going to, and not an energy exporter, is going to be hit by this, right? And so I think as you think about who some of the most vulnerable consumers are, and then I think to some of the points folks were talking about in the introduction, what's some of the drivers, again, we're used to weather, drivers of other uncertainty around the globe. Tell me where conflict is, and I can tell you probably where there are more folks who are suffering from issues of ability to obtain food.
John or Brandon, anything to add?
Well, I think Seth covered it.
Yeah.
Terrific. So, Seth, I know you had kindly prepared some slides that we're going to make available to all of our viewers after the webinar, but I would like you to, if you don't mind, just take us through a couple of your slides in your presentation, just to kind of continue this conversation from your perspective with regard to food and agriculture and food prices.
All right. So if I was gonna give you the rundown of what my slides actually talked about, I would have reminded you, hey, prices have been increasing since 2020. All right. And the prices had been increasing, and for reasons, again, that we're kind of used to in ag in terms of weather. China came back into our market late 2020, came into the market in general. We saw strength in commodity prices. The war certainly added a premium both in price and expanded the volatility of those prices significantly. We are now seeing prices kind of get back to pre-war levels, and we're seeing volatility in those commodity prices return to volatility come back to more normal. Now, still elevated prices, volatility more in the range of what we would consider normal. But to John's point, and to folks' point about falling commodity prices, that's what the signal here is. That absent another shock, and I hate to say that in what we've seen in the last few years, absent another shock, we should see commodity prices begin to ease. Okay, but we get the volatility because we're in a tight market position. The Black Sea Grain Initiative, again, doing better than I would have thought a year ago, could do more. The Ukrainians are doing a pretty good effort of getting that grain out. We still see some poor pricing in the Black Sea, both from Russia and Ukraine, and we can talk about why for different reasons. Russia's sitting on a record wheat crop and will likely have record wheat exports this year. And so, I think that part of the world is important in order to moderate prices. And I think if I were to give you the kind of the last take on some of this, it would be, as we saw rises in the FAO food price index, concurrent, we saw rises in export controls. I'm not saying one is a cause of the other, that they feed on each other and they exacerbate each other. And so I think if I would put out there, if I'd show you an export, I have an export restrictions matched with the FAO food price outlook, you see those things exacerbate each other. They feed on each other and cause even more volatility.
Seth, do you have that as a slide? Is that something you could show?
All right. So this is David Laborde at FAO, and I had a conversation, and he presented this FAO food price index as the blue line, the share of calories that he tracks that are under export restrictions. And again, as he would point out, and I would point out, not causal. I can't say the blue line always causes the orange line or the orange line always causes the blue line, but they are certainly moving together. We saw certain actions. I think I'd also show you, here is some of those export restrictions. So you can see export restriction evolution from this crisis on the left panel, which is the red line, the previous food crisis, which is the yellow line, COVID. And you can see there's a natural reaction here for folks to entrench and pull back and say, we're going to try and insulate ourselves from the rest of the world. The problem is that both transmits that volatility into the rest of the world. And secondly, it is not long run productive for your own producers and your own food production stability. So I think in the US, we've gotten to the point where we understand that being a good, reliable supplier both helps, we want to help the rest of the world, and it helps our own producers. We don't sabotage ourselves by maybe making short run gains for consumers in the US that eventually causes them long run pain. So, I guess that's probably what I would have closed on, with a note saying, yeah, prices are likely to ease as we come into the year in the absence of another shock. But relatively speaking, for major crops, corn, soybeans, wheat, rice, we are at all four of them being in fairly tight market conditions, which isn't what usually happens.
Somebody mentioned, John, it might have been you, that there was more cropland brought back into production. And can you just speak to the volume of, how's that translated to volume of exports of agricultural goods out of the U.S.?
I think Seth may have a little bit more insight on this. The department has allowed more double cropping here in the United States. We did see, 2 million acres come out of the CRP program. But, when we plant well over 250 million acres a year, 2 million acres here, 2 million acres there is not going to move the needle significantly, but it was a step in the right direction.
Yeah, and some of those acres, certainly if they were in CRP, at least where we are in the Eastern Corn Belt, they tended to be the lower quality acres that, probably would take some time to bring back into full production or being highly productive. The other thing that you have to take into account is farmers are very economic, both in the U.S. and everywhere else. With fertilizer prices rising to the level they did last year, there were certainly, both in the U.S. and globally, a droppage in fertilizer usage, and some of those fertilizers have a longer term, kind of 3 or 5 year life. So we'll continue to see maybe some yield depletion that comes out of ground because of that. That can be amended over time, but to the extent that fertilizer prices are higher, that's going to impact the ability for the U.S. farmer to produce.
For me, I think this is there's a short run discussion here and there's a long run discussion. So, when we think about the department, we think about sustainability, you got three pillars. The first, for some folks, the first one that comes is climate. But the other two are in it, a food which is accessible and affordable, and farmers can make money growing it. So I think it kind of comes back to this philosophy that we were kind of touching on earlier, which is intensification versus extensification. You can help achieve your climate goals with intensification versus extensification. So applying technology, do we need that extra acre that's kind of at the fringe, or can we make more of this acre that we've already got in production? Can that help us achieve those environmental, food price, and farmer profitability goals simultaneously? And so I think that that's kind of the view that I think satisfies those three pillars simultaneously, instead of picking a corner solution on any of one of those three issues. Productivity gains within the United States and around the world is a land saver too.
Terrific. So we've got about 10 more minutes allotted here. I have just 2 or 3 more questions, but let me take a question from the audience. And by the way, to all of our viewers and participants, if you do have a question, feel free to type that into the Q&A tab on Zoom. We'll put that in the queue and we'll get it to our panelists. This question: is the banking crisis in the US and Europe impacting agricultural finance? Also, we talked about the debt ceiling. John, you talked about the debt ceiling debate. How's that going to impact agriculture? But maybe we can just focus on the banking crisis that we've seen unfolding in the last couple of weeks. Any perspective on how that's impacting agri-finance?
So I'll let these two talk about some of the details of the very current period, and I'll just lay out, at USDA, when we think about farm income, and as it was described, when you've got really great farm income, but commodity prices coming down, input prices rising, maybe not as fast, you're putting a squeeze on folks. When we think about input prices continuing to rise, one of the biggest factors in that is interest expenses. Okay, so clearly having an effect. And then perhaps some of my colleagues would talk about regional banking. We got a lot of small regional banks, which are the ones which support agriculture in terms of financing of operating loans, et cetera. But clearly from a producer standpoint, rising interest rates are adding to those input expenses.
Yeah, I think, the only thing I would say related to the banking crisis is small and regional banks, local banks are the backbone of U.S. agriculture. And the best tool for a farmer or someone in agricultural production is a lender that understands their business. So if we were to move to a system with only 4 or 5 large national banks, I think the typical farm producer is going to face a lot of trouble obtaining operating debt. So we're a big fan of supporting local and regional banks, keeping them in place. And it's not just for agriculture, it's for all local businesses, lenders that understand their businesses, that understands their business is really one of the key aspects of their success. So we want to continue to support those local and regional banks in the ag sector.
John, anything to add?
I'd probably argue that there's a relationship between the interest rates that we've seen and the position of managed money in the commodity futures market and the price of commodities that we've seen. So as these interest rates increase, they become more attractive investments than, say, having your money in corn futures. And that's having a real impact on price discovery.
Hey, Brandon, if we were in a canoe in Maine, I was going to ask you this question, but in a world of zero interest rates that we've come through in the last decade and interest rates being held artificially low, what got out of whack in the agricultural economy? If you were able to tie artificially low interest rates had a perverse impact on the price of X, where do you think that is showing up or had shown up?
Yeah, I think in any asset class, free money creates some perverse incentives. In the farmland space, we didn't tend to see a lot of debt that was used to buy farms. Maybe it was purchased with farms that were already owned free and clear, but low rates on the production side, probably fueled the desire for farmers to farm more and more acres. And in the U.S., you have the population of acres that can be farmed every year is going down because of development, conservation, aridity. So for farmers who want to stay in the business, they need to at least stay the same size, if not grow. So that could definitely create some opportunities, not just with low interest rates, but when you pair that in periods where there are high commodity prices, then you have this kind of thirst for growth on the behalf of producers, that when the tide goes out, whether it's rates going up or commodity prices falling, then there could be some real stress on those specific operators, not necessarily the system. So I think that's where it would manifest most in the ag sector that we've seen. The other piece is, frankly, we have a venture business that does a lot of ag tech type investments too, and there's a lot of money that will be vaporized in that space because of low rates and chasing hopes and dreams that have no basis in reality. So I think, in that sector, that's more of just a general tech venture comment that has a piece, investments in ag, but there will be a lot of money lost chasing things that were kind of a solution in search of a problem.
Terrific. We have another question from the audience. The UN came out saying 26% of the world does not have access to clean water. Can you discuss water supply and its impact on food and population?
I'll just touch on this quickly. I think, our investment thesis has always been built around water and investing in areas with not only plentiful water in terms of it rains when you're trying to grow something, but also you have recharging aquifers. I think there's going to be a reckoning period, at least within the U.S., for folks who have invested in areas that have water that's either insufficient for what they want to grow, or the regulation is going to become, very, very difficult to deal with. So I think that's going to continue.
Seth, anything to add?
I think I'd just add that this is going to be a source of needed adaptation around the world in terms of kind of, the statistic you throw it out is clean water. And that most important for where people are located, also important for growing. So I think that there is two important elements to this. And I think it's going to be a source of continued need for adaptation for some of ag development as we go forward. And again, let's not force ag production in areas where maybe it's not as well suited around the world, and do some intensification versus extensification. And probably water is a part of that as well.
So I'd like to, I don't know a better way of doing this. This is a question about the degree of and the severity of food insecurity globally, and maybe including the United States. So just specific to food insecurity, on a scale of 1 to 10, 10 being extreme crisis, 1 being things okay, where are we? Where are we, and where do we think we're headed based on the conflict and the war in Ukraine, all the facts that you so generously shared with us during this conversation? Where would you say we are right now, and what direction are we heading? Anyone want to take a first crack?
I'll take a first crack at it. And just from the perspective that, we're looking at on the Ag Committee, think about fixed income individuals here in the United States who have not kept pace with inflation. Your elderly people who spend a lot of their money on fuel, gasoline, or food supplies. They're in a tougher position today than they were before the war with the inflation that they're seeing in food prices. So that's one area that, again, as we work to reauthorize this farm bill, we know that our nutrition programs, help the elderly, help the disabled, help children. But there is a conversation to be had around able-bodied working adults without dependents and without children, especially when you have 2 jobs open across the economy for every unemployed individual. And that will be a conversation that I think we have, in the Congress, in the House, in the Senate, as we work on this next farm bill, because we are spending, $1.2 trillion in this country to deal with food insecurity issues. And it's responsible to have that conversation, especially as it pertains to work requirements in this program.
Thank you, John. Brandon or Seth, anything to add?
I'll go a little bit more global, if I might. And I'm not known for being an optimist, so I'm going to come off as an I'm a little bit more optimistic, at least in the direction we are headed. Right? We're coming off of some of these things. Commodity prices are easing a little bit, moving in the right direction. Energy prices easing a little bit, still high. Don't get me wrong, but moving in the right direction. I'm a little bit more optimistic that if world peace were to break out here in Ukraine, that the farmers would do what farmers do. It might look different, but they'd get back into those fields. We'd see, I'm not saying it's going to be easy. I'm not going to say it's smooth, but they'll get back there and do what they do. But what I am concerned about is what lessons that we learn coming out of this. I kind of told you about the last food crisis, and then we entered a period where, stocks got back to where they were. I don't know what we learn about this, right? I think we got to keep leaning into that and keep pushing on it and say, hey, what are we going to lean coming out of this? Because like I said, we had these same kinds of policy reactions, perhaps not as severe this time through, from lessons learned in the last food crisis. So optimistic, heading in the right direction, want to see if we learn the lessons this time that maybe we didn't learn last time.
So I see Major General Gray. I think we're about to be honorably discharged.
Negative. Now, this has been absolutely captivating. I actually have 2 questions. I'm going to ask the first one, and then I would like to ask a strategic follow-up, if I could. A lot of headlines out here about China buying farmlands. They bought Smithfield Pork, I believe it was, and we're seeing them buying lands around military bases and everything. What's the impact on farmlands in America with China doing that? I assume it's going to drive prices up. But more importantly, what's the Hill doing about this? So it's sort of a 2-part question there.
So that's an excellent question. And as I opened, I talked about visiting with Senator Rubio this week, and that was one of his concerns on foreign nations owning farmland or owning our agribusinesses. China owns Smithfield Foods. They also own Syngenta, and Syngenta owns test plots here in the United States where they work on their seed development. I think the question is, how much farmland do they really own? Obviously, there's a question around, sensitive military institutions, but it's not a whole lot of farmland. And then, what's the role of the government in scrutinizing every single real estate transaction? Is there an opportunity for USDA to be involved in the CFIUS process? That's obviously something for consideration. But I'll tell you that the conversation is much more broader than that now on Capitol Hill. It's not just foreign companies or foreign countries, but it's your real estate investment companies. It's your billionaires that own farmland. Capitol Hill is not stopping at just China and Russia and Iran with their agricultural interests. It's billionaires. It's Joe Burrow. It's Steph Curry that's buying up farmland. And again, it's your real estate investment. So, and I sat down with the farmland capital folks a couple of weeks ago and told them that this is coming. We're likely going to have hearings at some point because there are a lot of constituents around the country that raise that concern to their members of Congress or their senators. And so, again, I think that will be something that we have a hearing and a deep conversation about this 118th Congress.
Okay. Thank you very much. All right. So my strategic question now, we're watching, and I'm shifting more or less to the last session we're going to have, which focuses on China and everything. But the question I've got here is we're watching China come up with its global influence, if you will. We're moving all throughout Asia, Central and South America, the Middle East. Now, Xi Jinping and Putin are best friends and everything. Is China going to be using agriculture as a strategic weapon in the future? Are they buying up stuff in all these other regions? Are they going to start importing from the other regions? What's China's ultimate goal with agriculture throughout the world?
I'm not sure if any of us know, but I mean, China does import from everybody. They, 2/3 of the world's soybeans end up there. So I think over the last decade, some of those infrastructure investments they've been making have been in order to secure supply for themselves. I think that's one of the concerns with this foreign ownership of U.S. farmland, like what's going to happen to it. I don't think it's a huge concern of mine right now. I feel like, one thing we did learn out of the Ukraine conflict that was surprising was that food was not used as a weapon as much as it could have been. And maybe some of that was self-preservation on behalf of Russia, but I think overall, I'm less worried about that food would be that weaponized vehicle.
Bill?
I guess I'd go back to if you all don't, I'd go back to a little bit again. The normal uncertainty we're used to dealing with in agriculture. We know very little about the internal Chinese market, even though USDA follows these things very closely and Amos follows these things very closely. As a USDA analyst, China doesn't report what its stocks of. We think they have the largest stocks in the world of some primary agricultural commodities, but they neither report nor do we know. It isn't, some markets are open, like soybeans into China, other markets like corn, not very transparent. And so I think from that standpoint, and then we see the Chinese also trying to broaden out their access of supplies. We used to be one of the few, us and Ukraine used to be one of the few suppliers of corn. They're now taking it from Brazil. So obviously their strategy is to broaden out their suppliers. We don't have good insight into the rest of their market. But when you think about regional influence, I think I think U.S. agriculture is a great ambassador into the region. You want to raise poultry in your country? We'll supply you great soybeans in order to crush to do so. You want corn to feed to your livestock? We can do that for you too in Southeast Asia. So I think it is incumbent upon us to build those markets and say we are a reliable supplier when it comes to food into your country.
Terrific. John, Seth, and Brandon, thank you very much. David, I'll turn it back over to you.
Yes, thank you, Bill and Seth, Brandon, John. John, it's nice to see you. You don't look like the United States Senate. That's a compliment, by the way.
We're in a recess today, so I
Yeah, well,
don't
you're
have to wear a
allowed.
suit.
You're allowed. We've had a very meaty discussion. We have the oil and gas discussion immediately ready to follow this one. Just one last question in a sort of a lightning round issue. As you know, the Global Interdependence Center has been involved in looking at sanctions and payments worldwide. We've been looking at it because what we see, and Brandon was with us in Havana, where we see the payments impediment from American sanctions preventing the sale of chicken from the United States to Cuba. We're not talking about rocket parts, military equipment. What we see in other places is a mixed policy of connecting the payments broad system as a penalty with policies which involve humanitarian aid, medical, or food. Syria is a case study. So when we look at it, the list of countries in the terrorist list, we put Cuba in the same category as North Korea. Somehow, I haven't seen any rockets fly over Florida from Cuba. So that leads to this now complex question. There are multiple payment systems in the world, and they overlap, mirror the Russian system, which is evolving in opposition to the SWIFT US dollar-based system. Agriculture requires payments, trade credits, all that activity. Could you spend a just very brief second, because we've got to get to the energy section, on this issue of payments, ag, trade credits in this, what is now a multipolar world? And then Bill will have to close and go to the energy section.
Well, I'll jump in here, and David, you and I talked about this over the phone a couple months ago, and you know, I had an opportunity to sit with the senator, recently and talk about it. And what I'll just say is, I've been in Washington long enough to know not to step in it, and this is a very political issue that I think is something that is happening above my head, and I don't really have anything to add at that point.
Seth, you're in Washington too.
and I'm a career employee. I think I need to point that one out. I'll just say, hey, there aren't sanctions on fertilizer or food. And I think anytime we introduce any kind of friction into trade, it's largely the producers at the origin who get the biggest effect on this, but also consumers worldwide. I'll leave it at that. I think there's a lot going on here in terms of transportation, et cetera. So I don't think I'll comment on the payments directly.
Well, we thank you, Bill Kennedy. Thank you, Brandon. We thank you, John, Seth. Safe journey. We're going to move immediately to the oil and gas energy panel. So thank you, gentlemen. Let's set up the next session. Thank you very much. Well, all right, Todd Engelhart will moderate this panel. Go right into the microphone so we record you. And welcome. Oh my gosh. So we have one Fisher that we know and another one that we're going to meet in August. So we've got two Fisher persons on the call. Your call, Todd.
Good morning, everyone. We have an excellent segment this morning on oil and gas with us. is Christy Tezak of Clearview Energy Partners and Jim Slutz of the National Petroleum Council. We have much to cover, so I'll get right into introductions, first with Christy.
Thank you so much for having me. I am sorry we could not all get together in person, but soon, very soon, as David says. Clearview Energy Partners is an independent research group here in Washington, D.C. We help institutional investors and corporate strategists understand how legislation, regulation, and politics are impacting their portfolio, whether that portfolio is made up of hard assets or secondary equities and a little bit of everything in between.
Jim.
Good morning, and it's a pleasure to be to join the GIC again. So I'm Jim Slutz. I'm with the National Petroleum Council. We're a kind of a unique organization. We're a federal advisory committee, but unique in that we're privately funded and we are non-advocacy, and we exist to provide advice at the request of the Secretary of Energy that goes across the administration, and our membership are about 200 members appointed by the Secretary and primarily CEO level folks across the energy space, producers, consumers, transporters, and civil society groups, NGOs.
Thank you, Jim. I'd like to begin by posing a backdrop thought and ask the panelists to comment. Jim, first, would you kindly provide a short summary of oil markets over the past 3 years from the 2020 price low, which was obviously attributed to the COVID pandemic shutdown, to its high in March of 2022, in part caused by the uncertainty over the Ukraine invasion, and the role as well of the United States as a producer, importer, and exporter of energy?
I'd be happy to. Let me first, I'm going to do a little tie-in with the last panel. Brandon mentioned the high cost of fertilizer, and what wasn't mentioned, but I think is an important tie-in, is that what's one of the biggest feedstocks of nitrogen fertilizer is natural gas. So that is the big driver of why fertilizer prices were so high last year. So I just wanted to add that in to tie into the panel, but let me very quickly, I'm going to jump back a little bit more than the 3 years because I think it's important from historical context. Between 2008 and 2019, the United States added 5 million barrels per day of oil production. Kind of unprecedented, unanticipated in many ways, for especially those of us that personally served in the Bush administration. We would have never conceived that. So, and then we had the price change in. Let me add that 5 million barrel increase, that is in a 2019 market of 95 million barrels. So then you had the pandemic that came in. You had a pandemic low of minus $37 a barrel for a brief time. So incredibly disruptive, followed by after recovery from the pandemic and the Ukraine war, a high of $130 a barrel in March of 2022. That precipitated the historic release of oil from the Strategic Petroleum Reserve of about 600,000 barrels a day in 2022. And I think it raises just the fundamental question of what is the future of the petroleum in the energy supply mix, and how do you balance the energy portfolio to achieve economic growth, energy security, and environmental stewardship?
Christy, could you add a few data points regarding what natural gas prices have done over the last few years?
Certainly. I'm also going to jump in the Wayback Machine a little bit, as Jim did, and talk a little bit about how natural gas fills an important role in the electricity sector. There was a time back in the early noughts that I remember when pollution control regulation in the United States was predicated on a long-term assumption that natural gas would be somewhere in the neighborhood of $6 to $8 an MMBTU, and that is certainly not what happened. As Jim mentioned, those magic years around 2008. The proliferation of hydraulic fracturing really unleashed additional natural gas capacity in the U.S. as well. And natural gas dropped structurally out of that plus $4 range into a sub $3 range between 2012 and 2020. And at the same time, that challenged the clean energy components of the electricity sector to find economics in their costs, as well as the preferences that they were getting under the U.S. tax code weren't enough to fully bridge that gap as natural gas got cheaper and cheaper. So what we saw is starting in 2014, the Environmental Protection Agency in the United States started moving ahead with some significant controls on hazardous air pollutants, which managed to push about a third of U.S. coal capacity off the grid. And then combined with the structural shift downward in natural gas prices really did start to push an uptake in natural gas demand in the U.S. But hydraulic fracturing was sufficient to help fill that gap pretty quickly. And so what we've seen over time is a shift away from reliance on coal-fired energy to supply the electricity sector. It dropped from over 37% down to 30% initially, and is now down to 19%. And natural gas expanded to 39% of the U.S. energy stack. And over the same interval, we've seen renewables grow from about 12%, including hydro, which is a magic variable in the U.S. renewable energy portfolio, and has grown to about 23% in 2022. So you've seen a significant shift in the reliance on natural gas in the United States. But since 2016, environmental advocates have targeted natural gas's role as a bridge fuel, really calling that into question, given what has been a groundswell of discussion over whether or not continuing to use natural gas, even if it at its lower greenhouse gas intensity, is really a wise thing to do politically. And so we've seen pressures there. Also, the transition to cleaner energy technologies is not easy. It requires investment in U.S. infrastructure. Well, not just U.S. infrastructure, but infrastructure anywhere. And that's linear infrastructure. And linear infrastructure is complicated not only because it costs money, but because it goes over a lot of people who do not necessarily directly feel that they tangibly benefit. So we've seen a lot of change in the last 20 years in how natural gas has participated both in the U.S. electricity portfolio, but also around the world, including in Europe, as there was a similar shift away from coal. And so this was sort of the precondition that we were wrestling with going into 2021. When natural gas became constrained going into Europe beginning in 2021, coincidental with the imminent deployment of Nord Stream 2, that created additional questions in terms of natural gas's role. Is it reliable? Is it reliable from a national security perspective? And then in the U.S., we had a couple of weather events in 2021 and 2022, which have provided different ammunition for the environmental community to question natural gas's reliability by saying it's not as reliable. You can't count on it as much if we have freeze-offs upstream in the production sector that impede the ability of it to be delivered to be relied upon for electricity, especially if a decarbonization agenda includes electrification. So that was a big pile on, but I hope that sets us up for a good conversation going forward.
Very good. Jim, the U.S. is a refined product exporter. If supply is tight, why not just stop exports?
That's a good question, a question many people asked last year. And one of the challenges, and I think it was addressed in the last panel on agricultural products, and that you really need this free flow of trade. And it's similar in the energy sector, is that these refineries are tuned to produce certain optimum amounts of different products, and you need to in order to optimize the refinery and produce the lowest cost fuel, you need to you need to move that fuel to the best and most useful market. And so there has been analysis that if you stopped exports, you actually would increase the cost and restrict the availability of supply in the U.S. And let me give you one. This actually ties all the way back to the oil and natural gas production. And let's look at something like propane, which is in the industry is called a natural gas liquid, but everybody knows propane is what you use to fire up your backyard grill and stuff like that. But so the United States exports about 50% of the propane that we produce. And that propane is produced largely along with natural gas. And quite frankly, it's been a large growth in production, largely from what are the areas called the Marcellus and Utica shales, which are Ohio, Pennsylvania, West Virginia. And so if you restricted the export of propane, what would you do with 50% of your production? You wouldn't have any, you would have to shut in vast numbers of wells. You would quickly run out of storage. And in fact, running out of storage was what precipitated that huge price decline in March of 2022 when demand went down. So it's just you got to let the market work if you want to be efficient in in this complex system in the U.S. That means you have to move some of the product out. And then it actually becomes even more complicated because of some of the regulatory structures in shipping products in the United States. And I won't dive into that, but it has to do with something called the Jones Act, and that you have to move goods from one port to another port in the U.S. on a U.S. flagged vessel. So there's all sorts of complicated systems, but in order to have the lowest price for consumers, you got to let the market move the product.
I'd like to ask both of you to comment on this next question. Well, we can start with Jim and then have Christy comment. Why does the United States import crude oil and at the same time export domestic crude?
So the U.S. is a net importer by an amount, so we would need to import some, but it goes back into how our refineries are configured, and these refineries largely were built, decades ago, and they've been upgraded over the years. And all crude oil is very different qualities, and they were designed to process heavier crude oils, and the newer this much of that new 5 million barrels of incremental production is lighter crude oil, and so it can be more. It's more cost effective for the refiners to import heavy crude oil and export light crude oil. And it just, again, creates a economic benefit for consumers. Hope I didn't take everything, Christy. You might want to take that into some export of natural gas issues, because I think there's similarities.
We've agreed to do a little bit of a division of labor here, and I'm going to tread ever so delicately into an area that I know Jim knows better than I do. But for the purpose of varying the speaker voices, natural gas too is not limited to domestic production and domestic consumption. In fact, in North America, we have a pretty broad market. We have long imported natural gas from Canada, from the north. In fact, some of the most critical storage for natural gas in the off season for the United States is actually located in Canada in the Dawn Hub. And we send U.S. produced natural gas now that we've gotten a lot better at it in the wake of our the deployment of hydraulic fracturing, we send gas over the border to Canada and store it there and then re-import it to the Midwest and to the Northeast United States in the winter months. And so what you see is a greater exchange, an exchange situation there that we have now. And so when you speak strictly to import and export volumes, we're capturing some of that activity as well. But the expansion in U.S. natural gas production has also led to an ability of the U.S. to support natural gas export to both Mexico and to the Caribbean, both near neighbors, and in terms of, globalization and proximity, that's a very natural expansion of that market. And, now we're talking about LNG exports. There was a time when we were talking about fixing the natural gas delivery system to handle LNG imports. And when we were able to expand production here in the U.S., then it became a very quick conversation to figure out how to retool those existing facilities, which is where we started, so that they could liquefy the gas instead of gasifying it, and to send it abroad. And that has been helpful when it came to the European Union needing support of additional natural gas volumes starting in 2021 and 2022.
Jim, I have a question for you. How quickly can the Strategic Petroleum Reserve be refilled?
Well, it's an interesting question, but it begs a few additional questions, such as what is the optimal size of the Strategic Petroleum Reserve? It has at one point had a maximum fill of 727 million barrels, and I'm personally a bit vested because I actually signed the purchase order that topped it off in December 2028 when I was in government. But that goes back to that. I think one of the challenges in deciding, there's a couple of challenges in deciding how quickly or how to refill the reserve. First is how much do you need to fill it? And how do you want to, and that goes into how should it be used. And then the other issue is that obviously the U.S. received a lot of money when they sold that 216 million barrels in 2022. But what many people don't realize, because of some prior federal budget, requirements, about 2/3 of that was just transferred to the Treasury, and about 1/3 of that money was left in the account to buy oil. So you have about the money in that account is about enough to buy, I think I've heard 60 to 70 million barrels, depending on what price you are buying it at. And then you get into the issue from a government standpoint. Obviously, we released oil from the reserve because to push prices down. We don't want to buy so much oil so quickly that we push prices up. There's also huge logistics challenges in that the same pipeline system that the SPR uses is the commercial pipeline system largely. So there are limits on that, and there's limits on how much you can bring in. And I think while you can release about 4 million barrels a day theoretically in a maximum, the amount you could bring in is far less than that. Let me just share one of the easiest ways maybe to share is so say we wanted to bring in 60, 70, or 200 million barrels. I think the illustration of how long that would take is to look back in history. I mentioned that procurement order I signed to top off the reserve. That was to replace that in 2008 was to replace the oil that was released during Hurricane Rita and Katrina, which was 11 million barrels of oil. And we decided at that time that we should limit the purchase to 1 million barrels a month, not to avoid impacting the market. So whatever the case, I think if you want to replace it in some kind of reasonable amount of time, you're going to have to bring in more than that. But you're talking even 60 to 70 million barrels, you're talking years to bring that oil back in. One other final point is, since I work for the National Petroleum Council and this references a report, the Secretary asked the Council for their advice on a number of energy market issues last fall, one of which was a recommendation that the Council made that the government should delay refilling the reserve until the market kind of stabilized. And so I share that. That report's available on our website along with much of the information I've stated. Sorry for the long thing, but it's a very complicated issue of how you go through that, let alone the fact this is a government procurement mechanism, which I think, to give you a sense, back in that Hurricane Rita, Katrina, we tried, I think, 3 or 4 times to actually do solicitations before we were able to get a price that was acceptable to the government. So that's why it took 3 or 4 years to refill, and that was 11 million barrels.
Very good. We need oil and natural gas now, but there are calls to reduce or eliminate oil and natural gas production. How do we reconcile current needs and future decarbonization? Christy?
Well, I think that's part of the challenge, because it is, as I mentioned briefly earlier, energy transition is not an overnight event. And it's not an overnight event because each resource needs a certain amount of infrastructure. And you can look, whether you're looking at Europe and, from a big picture perspective, Nikos Safos actually mentioned this week. He's now an energy policymaker in Greece. And he noted, the natural synergy of, wind in the north of Europe and sun in the south, and how, creates all sorts of opportunity to, to balance those two resources, which are lower emitting, and to further the cause of, and the agenda of decarbonization. But, the discussants on his LinkedIn page were quick to leap on the fact that, infrastructure is not exactly something that materializes with the proverbial, wave of a magic wand. It is, it requires new technologies. We've got serious discussions now in the U.S. about the challenges of integrating the inverter-based resources, which are solar and storage, and how they interface with rotating generation that is, provided by thermal resources. And so these are non-trivial issues. And when you start talking about the challenges of cost, when we're in an environment where we've already seen costs go up, and we're seeing challenges in terms of what consumers are facing, to layer on another component of infrastructure support starts to be a real political challenge, because, electricity, for example, is a public good. And we're seeing very similar discussions in the U.S. The fracking boom and the drops in costs for renewable technologies have similarly dampened U.S. generation prices and have muted some of the investments in distribution and in adopting newer, more expensive technologies that would otherwise have been more apparent, say at $6 to $8 gas. And so now you've got customers facing volatility, which they find unwelcome, and this conversation about how now we have to build a huge infrastructure in the United States in terms of building out the grid in order to support a decarbonization agenda. So what you're seeing is, I think, a real timing challenge. You certainly have a constituency that thinks that everything we need to do on decarbonization needs to happen today, preferably yesterday. And the reality that you can't just plug in several thousand gigawatts of new intermittent resources to the grid without that having a significant operational impact on keeping the lights on. And this is a very significant tension that we're seeing now. And I think we see it in Europe, and we see it certainly here in the US, because there's a lot of ambition, but nobody really wants to pick up the tab.
Jim, thoughts?
Yeah, so a couple of things come to mind. First, and we could spend, I think, the entire 45 minutes just on this topic. But one, I think it's important to fundamentally remember, if you look at the 200-year history of energy sources have been additive. We haven't really replaced one energy source with another. Like, one of the examples is if you look at biomass that 200 years ago, biomass was the biggest share of energy. I'm talking about wood and things like, and related items. And so we've grown all these other energy sources, and biomass is now a small percentage of the total global energy use, but its actual volume of energy is not changed all that much. And so I think that is one of the big challenges. Is we have a growing population. We are becoming more energy efficient, and that's very important. So we have a lower per capita energy use, but we still have a greater energy use across the board. And I think the other thing goes to Christy and kind of working through, whether it's leaders in the investment community or the political leadership, is helping them understand the scale and scope of the energy system. And that's, it's taken 125 years to build out the current electric grid. And so is it really realistic to increase its size by 25% and change the existing 80% of energy development in a 10-year time frame? I think we have to really kind of focus, figure out a more systems approach to looking at the energy changes.
It's David, Jim, Christy. Let me. You can't see what's going on in the auditorium as we're moving cameras and moving things here, but let me ask a question that the Global Interdependence Center has been looking at or investigating or fact-finding. You're in the oil and gas energy business. It's a worldwide business. Up until recently, the payment systems were centered on US dollar. Now we have a competing payment system, which is Russia and its relationships, the MIR system, separate from the SWIFT US dollar-based system. And we have some countries that are in both, India, Indonesia. In this system, we also have this strange relationship of various countries in oil. Venezuela. How do we get a Venezuelan load of crude to a refinery in Corpus Christi? Somebody has to pay for it. How do you transfer it? What does Cuba do? It's not in the U.S. system because of the designation of the Trump administration 6 days before Trump left office. It needs energy. But what we saw is it has to get it from someplace. And the payment systems for a place like Cuba eliminate the US dollar because of American sanctions. They can't buy food, they can't buy energy, they can't buy medical supplies. I saw it with my own eyes in Havana in January. So in this multipolar, crazy payment system world, can you say a little bit about trade credit, payments, sanctions, because it's a new world from what we knew just a couple of years ago?
Jim, why don't you start?
Well, the payment system is kind of out of my depth, but what I could do is just maybe talk broadly. And I think what is that clearly without, there was all the interest in whether it was sanctioning Russian oil, but clearly the world couldn't operate without some level of that oil. And so all the challenges with many of the challenges with sanctions of how to limit the revenue for Russia, but also not completely eliminate the oil from the market. because of the world needed that energy. So I think that, is, but I'm not, I'll have to let Christy, I don't know if you have some sense on the payment system and some of the movement of trade. It's not really my area of expertise. I'm a little more on the technical side of the business.
Yeah, we haven't looked specifically at the implications of the payment system, David. But certainly in terms of sanctions, one of the things that we will be paying attention to and have been paying attention to is how, efforts to manage the price of Russian oil and Russian gas are leading to displacement in terms of those cargoes. And, the recent announcement of the expansion of the Power of Siberia pipeline to China, and how a structural shift to China consuming to consuming additional volumes of Russian gas, those sorts of implications on the LNG market, because if they have less dependence on LNG imports, then that's going to impact not only U.S. LNG production, but certainly LNG production throughout the world, as those project developers are looking for customers. The impacts on, for those countries who have not participated in sanctions, lower priced Russian oil is a real opportunity. I think we've seen that in the change in the purchasing behavior of India that Ariana spoke to yesterday. So I think that, those are the things we've been watching more, I think, than the implications of the clearing, because I think that the clearing is sort of following the commercial desires more than driving them at this point. That's just my impression. But I'm willing to confess that may be my own myopia.
We have another question from the group here. The green movement would shut down oil and natural gas if it could. Nuclear is off the table. Is the oil and natural gas industry cleaning up in order to help the environment? Christy, why don't we start with you?
Yes, I think they are. But I think that it is accurate to also say that the ambitions vary by market participant. You definitely have some companies that are leaning more aggressively into alternative energies than others. There's also significant interest in carbon capture and sequestration because that is something that is an opportunity to manage the threat of climate change and the growing density of CO2 in the atmosphere, and not limited specifically to end use capture at a power plant. But also, we're seeing additional investments in direct air capture. And naturally, I don't think it's a surprise to see the environmental movement disparage those efforts as so much greenwashing or an undesirable pathway that would continue to use fossil fuels. But darn, those things are energy dense. And there is definitely, I think, a natural financial motivation by companies who are expert in those fuels to find a way to preserve their continued use. And I think Jim made a huge observation that is, kind of hits one between the eyes, is usually we talk about adding to our energy resource mix and not subtracting from it, let alone throwing entire components of it off the table. And what we've seen, certainly in the last 2 years in the United States, and is to a lesser extent in Europe and to a certain extent in Japan, is all of a sudden nuclear is back on the table, even though a lot of environmentally oriented groups don't support that. And it too is energy dense and can be a very significant contributor to baseload without adding to greenhouse gases. So I think we've seen the conversation change a lot. Beauty is in the eye of the beholder, to be sure. But I think that there's going to be continued effort to preserve existing assets because this wholesale transition to an entirely new ballgame, while it may happen eventually, I don't think it happens on the timeline that its most ardent advocates would like to see. And in the meantime, people need heat, people need power, and economies need fuels in order to make the things that literally make the world go round.
And
Jim?
Todd, if you don't mind, I'll jump on that a little bit because I think you are seeing significant movement, and it's not surprising the very largest companies have the wherewithal to look at their operations and make investments, for instance, to reduce fugitive emissions and things like that are important step. I think as you get down to the smaller players, it's more challenging because they are operating more of the marginal assets. But I in working a lot with, I work very much with the oil and gas industry, and there is a huge commitment to reduce their emissions. But I think at the same time, we have to look at we need to look at the value added for some of these energy components, and it's not easy to change. And so on a cold winter day in the United States, twice as many BTUs or energy units come from natural gas as come from electricity. So that is a huge amount to overcome. If you wanted to I've seen some work. If you wanted to replace those with say battery backup systems, you'd need 66,000 of the world's largest battery storage facilities in the United States. So those are phenomenal sizes of facilities. So I think one of the things I opened with was this idea. I think a year ago or more before the Ukraine event, everybody was very focused on the environment. And I think now there's much more of a recognition that the environment is critically important, but we have to figure out how to balance that with energy security and economic development. And energy is fundamental across all three of those.
Do we have a little more time? Okay. I'd like to ask a question of both of you or have you comment on it. We've spent most of our time this morning talking about U.S. energy supply and demand. This conference is sponsored by the Global Interdependence Center, and there aren't many commodities more global in economic impact than energy, particularly oil and natural gas. The U.S. has been forced or focused on the environmental impact of energy, especially when we look at the Inflation Reduction Act and other laws passed this year. But what are the perspectives in other places around the world regarding energy? Jim?
I know we're short on time. I'll be brief. Well, first, so when you look at kind of I think this whole issue of energy security is just front and center right now across the world. And when you look at how we deal with the environmental stewardship side of this, it's really going to be driven by Asia and Africa. That's where the demand growth is for energy needs. And that's why it's going to be just absolutely critical that we have international dialogue, international engagement. One final thing just to say is I'm incredibly optimistic on our future, even though with these scale and challenges is you see there's phenomenal advances in technology, small scale nuclear and other technologies that I think have this opportunity. And I think one of the key challenges is that we be careful of how we do policy so that we don't inadvertently, inhibit that market from developing those new technologies and opportunities.
Christy?
I think what we're going to see in a lot of those same areas that Jim mentioned where energy use is really growing, particularly in nations that are still electrifying, is we're going to see a different approach. We're going to see a lot more emphasis on distributed energy resources. Smaller microgrid solutions, I think, are going to proliferate. It's not unlike the opportunity with telecommunications to go from, just skip right over hard copper lines and go right to cell phone service and mobile telephony. I think there's a similar opportunity that we'll see play out combined with the desire of many nations to have better environmental stewardship, and that means lower greenhouse gas emissions, and that is an earlier commitment to renewable energy. I think the challenge in deployment is going to be, again, a who pays for it thing. Developing countries would really like developed nations to throw in and help bridge that gap for them with these more expensive technologies. But it could be a useful proving ground. While I think that, the deployment of a gazillion batteries based on current technology that Jim mentioned is a daunting figure, the opportunity to have, a sandbox, if you will, to test drive technologies and find efficiencies. I mean, one thing I will say about the energy industry is that no matter how onerous the regulations that are coming down the pike seem to be, they always seem to do a little better in terms of compliance for less than originally feared. And so I think that opportunity still exists, but exactly how much we can do and how fast, I think, remains an open question and a challenge.
Thank you. Thank you. Any other questions? Mr. Kotak.
Yes. Thank you, Christy. Thank you, Jim. Look forward to seeing you both this summer. Todd, thank you very much. We will thank our energy, oil, gas panel. And we now have the ability to immediately segue to the discussion of central banks' spillover effects. So let's change the panel settings and we'll say goodbye to you. It's nice to see you.
Good to see you, David.
All right, be safe. And let's move to the next session. I see Kasia and Catherine Mann and Mike McKee. That's quite a lineup. So, Kasia, I know you're in Warsaw. Mike, are you in New York?
I'm in Washington, D.C.
Washington, D.C.
In a conference room I've never been in, so I hope that I've got this lined up right for Zoom.
So, and Kathy, you're in London.
No, actually, I'm in Washington right now.
You're in Washington.
Different conference room, different. But I'm on the East Coast.
So here we are with three major cities of the world: Warsaw, Washington, and Sarasota, Florida. I won't get into the rankings. This is a remarkable discussion, because the discussion, which will be moderated by Mike McKee, who in the last few days has gotten a little attention on Bloomberg television, at least I've watched him there, with activities in the world that are extraordinary. And Kasia, you're up against a meeting and a hard stop, so we've reorganized things so that we can hear from you first. While we're in this discussion for background, we're already having discussions here. And so a comment or two about Poland and the humanitarian refugee Ukrainian resettlement situation in Poland. Poland has done such a marvelous outreach in this world to help people who are so oppressed. So if we can sort of have a preliminary touch of that, Mike, before we get into the real meat of central banks and all that's going on with central banks, banking, and the spillover effects that we have. So let me turn it over to Mike McKee to introduce formally, and maybe then Kasia can go first.
Well, that is the plan, David, and thank you very much. I'm sure that whatever the weather is in Sarasota today, it is better than in the two other great cities of the world. Washington, D.C. has decided to make Kathy Mann at home by doing its best imitation of London weather today. And Kasia, I'm not sure what it is in Poland today, but it doesn't look as nice as it probably does as the Sarasota beaches. As David noted, our guests today are two really distinguished members of the central banking fraternity, Catherine Mann, who's a member of the Monetary Policy Committee of the Bank of England, and Kasia Zajdel-Kurowska, who's a former member of the management board of the National Bank of Poland. Both of them have extremely long and very impressive resumes. I'll just note that Kasia has been Undersecretary of State in the Ministry of Finance. She's has been deputy chair of the Commission for Banking Supervision. She was Poland's deputy executive director at the International Monetary Fund. She knows international banking. She knows international economics, and she certainly can tell us something about Poland. Kathy Mann, who, if you are a member of the GIC and also a member of the Camp Kotak fraternity, you know her well. She is not just a member of the Monetary Policy Committee now, but she too has an enormous resume. She's a professor of the practice at Brandeis University, but also spent time most recently as the chief economist at Citigroup. She is also a former director of economics for the Organization of Economic Cooperation and Development, the OECD. And so she has a wealth of experience in the public and private sector as well. And so we're very excited to have both of them available to us today. As David mentioned, we do have a bit of a time constraint with Kasia because she has a hard stop meeting, although moving up this session a little may help us a little bit. But what we agreed to do was have Kasia start us off, and we'll run this a little bit differently than the other panels because if she does have to leave, we want to get some questions in. So you could raise your hand or put, I guess we put questions in the chat function when Kasia has finished with her opening presentations or something. And we'll talk to her primarily. I'll have Kasia make an opening statement and Catherine, and then we'll focus primarily on Poland and Europe for the moment so we can get as much out of her before she has to leave, and then we'll turn to Kathy Mann. So let me thank you both for joining us. And why don't I start with Kasia asking you what you're seeing right now, and as David said, a little bit more about the situation for Poland itself beyond just the banks.
Thank you very much, Michael. I do hope that you can hear me well. And good morning to everyone here. I am in Warsaw. It's already afternoon, and the weather is, as usual in Poland during these times, is cloudy, and I'm really missing Washington's blue sky. Definitely, there is a lot of going on regarding Ukraine, and this is a great topic. And I very much would like to thank organizers and David for inviting me the second time to this excellent series of events to talk about Ukraine and about the spillovers effect 1 year after the war has started. So, the topic of our panel was how do monetary policy makers deal with spillovers effect from food, energy, and geopolitical in the bracket war, and shocks that are beyond the policy makers. Well, I have to admit that I was listening carefully this morning about the implications, the spillovers on the food and energy market, and definitely we can say that those spillovers are significant for inflation worldwide, not only Europe, not only countries that are neighboring with Ukraine, but globally, this is the global phenomenon of higher inflation. However, I have to admit that when I analyze that about what is the real impact of the energy, food, and geopolitical, we might see that in the perspective. Because we see the higher inflation as the effect of more factors that started already 10 years ago after global financial crisis with the huge stimulus and monetary loosening by central banks, but also loosening of the fiscal policy. So we had a huge stimulus that was difficult to withdraw because there was a huge uncertainty about the future implications and the GDP growth, because the growth remained very low and endemic. So central bankers decided to keep a very loose monetary policy. Then when the situation stabilized, we had an enormous shock, which was pandemic, and again central banks decided to keep relatively loose monetary policy together with additional fiscal stimulus that was offered by policymakers. And Poland was the same, not other country. So the same policy makes as in other countries we saw here. And as we saw the end of the pandemic and the situation seemed to be much better, we noted some light in the tunnel. Then central bankers decided to tighten monetary policy, but it was just before the war started. And we already had accumulated shocks from the past big events, which was the global financial shock, and then of course the pandemic. And in February last year, we added additional global shock that affected prices of energy and food in particular, but we had all effects regarding the disruptions in the supply chains and so on and so on. But we have to remember that those prices started rising already before the war, but the war added much more, and inflation increased everywhere. However, I also analyzed a little bit the situation between developing countries and advanced countries, because the structure of the consumer price index is a little bit different in those countries, and those developing countries with much higher share of the consumer of the food and energy in the CPI basket were hit more than advanced countries with the larger share of services rather than food and energy. That's why you can see that particularly in Europe, those countries with the lower level of income were hit more in terms of CPI, and we see much higher inflation in our region, in Central Eastern Europe, because the level of income in those countries and development is much lower than in Western economies. That's why inflation remains elevated. And what was the response of the central banks? Of course, they continued to increase interest rates, and in Poland, the main reference rate of the central bank was raised from almost 0 to 6.75, which is quite a high level, the highest over 20 years. However, inflation is also the highest over the 20 years. And unfortunately, it's persistent and remains high. And despite much lower oil prices globally, inflation remains relatively high. What we can say about the shock, whether this would remain for longer, is very difficult to say. However, as the result of persistent inflation, we observe stronger wage pressure that has already increased the so-called core inflation. And as we are in Poland and in other countries in the election period, more and more wage and pension increases are promised. So I don't believe that easily we will see much lower inflation despite monetary tightening. So this is what happened in Poland and in our region. However, I would like also add, as David asked about what happened in Ukraine, as Ukraine is under the war circumstances. And yesterday, World Bank launched the new report about the damage and needs assessment, and also a new forecast about the macroeconomic situation in Ukraine. And GDP, just to share a few data, the GDP last year in Ukraine declined by almost 30%, while prices increased to 27% year on year. Central bank had to mitigate those effects, had to introduce exchange rate peg to US dollar that provided a little bit nominal anchor for prices, avoiding further price increases. But the situation is not very stable, despite introduce some kind of capital control measures. And also the central bank had to monetize a large part of the government spending because the international institutions and donors couldn't finance the war spending. They could provide the budget support. So large military spending was somehow financed by the central banks as well. And the interesting that monetizing of government spending had relatively limited impact on money supply. But the situation remains quite difficult to manage. Inflationary pressure is relatively strong, and of course, as long as we will see the food and energy prices disruptions on the global market, we will see the impact in CPI in Ukraine, Poland, and other countries worldwide. Back to you, Michael.
Thank you very much. And now we'll turn it over to Catherine for a moment to talk about what it's been like from the UK perspective. And you have not just the war and global inflation going on, you got Brexit weighing on consumer prices and food prices there. So why don't you bring us up to date on where things are from where you normally sit, not where you're sitting today, but where you normally sit.
Well, thanks very much, Michael. A lot of what Katja has said is relevant for an advanced economy, the UK as well. We have talking about, if we go back a year to give us some perspective, as she did with her comments, COVID was presenting a supply shock to us that was driving up transportation, shipping, chips, the whole bit. And that was already a prelude to what was rising inflation at the time. So the energy shock that came in February 2022 with Russia's invasion of Ukraine was already on the back of something that was we were trying to already deal with as we had moved already to start our tightening cycle in December 2021. If we think about food, the issue there that I think is important to consider is that food is produced with a lag. Whether it's a planting cycle or it's growing a pig or something, there's a lag between the inputs and the outputs. And I think that's an important ingredient as we think about what's happening right now to both energy and food inflation. We had additional factors of the goods demand rotation continuing to be important last year. We're talking about pre-owned autos, the rotation that we thought would be happening with goods demand moderating in the global market was not something that we really saw. It was true we saw that goods rotation in the UK, but it was at a price level in the global market that was still quite elevated. We observed the services rebound in the UK, a very important ingredient. All of that, of course, is against a backdrop of a labor market that, in particular in the UK, has tightened because of labor force participation falling. That's something that we hear a little bit about in the United States, but it's not true in the euro area, for example. So the tightening labor market in the UK was on top of the other shocks. And then lastly, I think importantly to put forward going into where we are right now in 2023 is during 2022, there was really a buildup in price expectations, inflation expectations. And if we look at micro data for firms, surveys of households, financial markets, and so forth, we all expected that the 1 year ahead expectations would be high. Based, in 2022, looking into 2023, we expected those to be high because of, the 1 year backward lookingness. But we also started to see at the end of the year some drift, particularly in price expectations of firms. The view was if demand stays strong, we have a lot of input costs that we would like to pass through. We are going to be able to do that into 2023 so long as demand remains robust. And so that drifting of price expectations was a very important factor to keep in mind and, front of face. So the other factors that I think are critically important as we think about evolution into 2023 is, on the one hand, we do see a deceleration, really dramatic deceleration in wholesale energy prices. So that, based on the base effects, the deceleration should start to come through when we look at headline CPI. That's in our forecast. It really does represent a dramatic deceleration in inflation, and it will be more apparent in the advanced economies for the reason that Katja put forward, which is that the share of energy in the basket is smaller for a country, an advanced country like the UK. On the food side, however, this is where the growing cycle, or the whether it be products and vegetables or animals, this is where the food cycle becomes important, because all of those costs from last year continue to be persistent in the prices of food this year. And as well, this is a place where I think Brexit is important, because one of the things we've observed in the data is that the small exporters from Europe into the UK, and the UK does import quite a bit of food, the smaller exporters, which provided additional supply, additional competitive pricing, what we have observed is those smaller exporters from the EU into the UK really have exited from participating in that traded marketplace. If it's too expensive to get over the red tape and so forth. So that's an important ingredient when we think about sort of the underpinnings of food inflation. There's this lagged effect of the input cost, and there is this effect having to do with smaller producers from Europe deciding it's really not worth it to send it to the UK. Now, having that as a backdrop, what really matters when we think about the evolution of inflation into 2023 is how much of the energy price acceleration that we did observe in 2022 and for food that we're looking at now, how much of that gets embedded into core inflation. And again, since in the emerging markets or in the countries where food and energy are large components of the basket, as those wholesale prices come down, you'll start to observe it in the overall core headline, of course, and in core. But for countries where those elements are relatively small in the basket, well, then we start to talk a lot more about the embedding or the second round effects on wage developments, on pricing strategies of firms. And those, we parameterize those. We can think of them simply as services inflation, although that's too narrow. We have underlying inflation measures, which address the degree to embeddedness and so forth, that is domestically generated inflation. And that persistence in domestically generated inflation is something that is of greater concern right now, and certainly was of greater concern for me over the last 6 months as I tended to be more aggressive in my approach to monetary policy bank rate rises. The additional point that I would like to add is, and I think it's a differentiator to some degree between emerging markets and advanced economies, particularly in the UK context, this is important, is over the last years, particularly the last 6 months, last 9 months, and also we observe it in the budget that was just released. There's quite a bit of support for consumer energy consumer energy, the household energy prices. They've been capped. That arithmetically takes some of the top off of headline inflation. But what that cap does, even though it's still expensive, nobody says that anybody's getting energy for free here. But that cap does allow purchasing power to be transferred from energy to other goods and services, the domestic goods and services in particular. And that's part of the reason for this persistence and domestically generated inflation that we worry about, in particular, when thinking about monetary policy stance. And that, according to our most recent estimates, could be about 2 percentage points stronger household purchasing power compared to our February monetary policy report. There's still a hit to purchasing power. There's no getting around that energy is still expensive, food is still expensive, but we're talking about the rotation of purchasing power away from those externally generated shocks towards the domestic goods and services. I could add some more things about monetary policy, but maybe I'll leave it there, and we can talk specifically more about monetary policy strategy and the status of financial conditions. And turn it back to you, Michael.
All right, thank you, Catherine. Katja, I want to build on something that Catherine was pointing out, the supply shock that happened. In a way, you've had a combination of supply and demand shocks, but on the supply side, you've certainly had a labor supply shock in that I think Poland has taken in more refugees from Ukraine than any other European country. I don't know, you can maybe explain to us what their work status is and whether they can take jobs, but I would imagine that has been one of the biggest unknown factors about how the economy was going to play out.
Thank you very much, Michael, for that great question. Indeed, we have a very interesting reshuffle on the labor market, because before the war, we welcomed around 1 million of mainly male workers from Ukraine that were particular in the construction and transport sectors. And when the war started, they all returned or they were mobilized, or they had to, or they returned to Ukraine, while we had the opposite move of women with children and elderly people. That in the peak, it was around 3.5 million of people just after the first weeks of the war. Now the number is a little bit lower, when the situation, particularly in the western Ukraine, has stabilized. So some of those families return. So the number fluctuates around 1.5, 2 million of people that are permanently in Poland. And what is quite interesting, from very beginning, Polish government offered a full registration and services to access to public services to all families from Ukraine, so they can easily register in Poland. They have access to education, to medical sector, and they can work. They have work permit in Poland. So this is quite unique regarding other countries that hosted a large group of refugees or immigrants. We don't have any camps. They rent apartments or in Poland. Or they still live with some Polish families that they offered them their own accommodation, but also the government and municipalities provide some housing to those families. But what is the most important, that they have access to all public services, so they can officially work, and all kids they can attend school. Also, Ukraine Ukraine offers them, the children, they offer the virtual school, so they can also attend Ukrainian schooling by online service. But kids that are present in Poland can register, and they really attend classes in person in Poland in Polish schools. It created a little bit also demand for Ukraine teachers, because we don't speak Ukraine language. So it somehow also offered job to those women that came with children, and also when you come to, for example, to big cities like Warsaw, you see a lot of small businesses offered by Ukraine women. They produce some kind of dumplings that they can sell, but also there are a lot of women and young students or young people that work in the services sector. So somehow that gap was filled. However, we still have a kind of mismatch regarding the labor force, because, as I said, in the construction sector and transport, we have a huge gap which is not filled because those men are fighting in their home country.
Let me follow up by looking at the other side of that equation and posing a broader question. And that is, at the same time you had this supply shock of all these people coming in, that would have created a demand shock for the products and services that were available in Poland. How did the country deal with that? And then putting the two together of a demand shock and a supply shock at the same time, how did you approach monetary policy? When this was just beginning, you could probably see this wave coming at you. What was the way you thought about it and what you might have to do?
Well, you're right that we have in the same time supply and demand shock, and on top of that we have a global shock that affects the global prices. But with this big group of people that enter the country, the first what you can expect that was, of course, the demand shock on the real estate market or the rental market, because Poland still faces a problem with not sufficient number of the rental apartments or flats. So the number of available houses or apartments, the number is relatively limited. Even before the war, it was a problem for the Polish families to get the first house or apartment, because the prices are relatively high. So it created a kind of asset bubble, because first we had a rental market that the prices that affected the prices, and the prices increased a lot, but also it affected the housing or the new housing, the new housing, the beginning of the new houses to be built, because in the same time inflation increased and the central bank increased interest rates to accommodate that demand shock. So the mortgage loans became very expensive. So it cooled down the market and stopped real estate market a little bit. So indeed, there is a shock on the real estate market. So from one hand, we have a huge demand, both from Polish citizens, but also Ukraine, while the price of the credit remains relatively high because of the monetary tightening. So this is a kind of issue here. And also we might say that on the other side, we had this positive impact on the domestic side, because when people crossed the border, they needed not only food, they needed everything to start their new life in Poland. So it created positive shock, of course, in terms of the GDP. So Polish GDP remained relatively higher than other countries during the recession, while we had this negative impact on prices because prices increased. So the level of inflation in Poland is around 18%, while in other countries it's twice lower because of that situation.
Okay, let me remind folks that Katja has to leave early in about 10 minutes or so. So if you have a question for her, put it in the Q&A section. In the meantime, I'll turn back to Catherine for a moment. You joined the Monetary Policy Committee in 2021, and I'm sure that your brief at some point said, we've got to deal with Brexit, and we've got all these prices and things coming in that we're going to have to deal with. We have a political crisis going on where we can't seem to keep a prime minister, and on top of that, Her Majesty is dying. And at that point, somebody had to walk through the door and go, oh, by the way, Russia's going to invade Ukraine. So I'm wondering how, as you entered 2022, the world looked to the Monetary Policy Committee and how you thought about what you might need to do.
When I joined, I don't think that we fully appreciated the degree to which the geopolitical environment would unravel so quickly, and it certainly wasn't part of my brief. It wasn't one of the questions that I was asked to answer in my introductory presentation to the Treasury Select Committee. So if anybody knew about that, it certainly wasn't me. So let's talk about what is the remit? The remit of the central bank, the Bank of England, is price stability, to return the inflation rate to 2%. That is the primary remit. There is a secondary remit, which is to say that if we want to have 2% inflation at all times, but if achieving that requires drastic changes in underlying economic activity, or contributes to volatility in underlying economic activity, undue volatility in economic activity, then we can deviate from the 2% target. And I also will add that there is a third remit that was added in a third priority, which is to work with the government to achieve net zero. So there is an element of a climate objective in our remit as well. Now, there is, of course, so the bank rate is our primary instrument. That's the equivalent of the Fed funds rate for those of you who are more Fed watchers. So we call ours the bank rate. And that is our primary tool. And that's the tool that we have been using since, as I say, December 2021 in terms of raising it. And of course, we raised it to 4.25% and a quarter last Thursday. So that was the 11th time that we increased bank rate. Now, we do have another, we also, as with many central banks, engaged in quantitative easing. And we have an ongoing program of reducing the balance sheet of assets according to a plan, $80 billion a year, or 80 billion pounds a year, and to roll off those assets in a predictable way. Our internal trading function engages with the markets on an ongoing basis in order to ensure a smooth transition for those assets to enter into the private assets holdings. So that has happened and has been taking place with no ripples in the market, which is, of course, was the objective. So it's supposed to happen in the background. We did have a corporate bond portfolio, and that was a relatively small portfolio. It was, as it was rolling off, we chose to sell the sort of the dirtier assets first. So greening of that portfolio. It's small and it doesn't really represent a big contribution to the marketplace. Although there's some interesting aspects to it. So those are, that's our remit. This is what we do. And in thinking about the pace of bank rate rises, early last year, actually through much of the year, I tended to be on the side of a more aggressive interest rate, bank rate rises. The question is why? Why would I do that? And really, it was drawing on the research that the bank staff has put into place, which was, and the findings from that research, which was if there's uncertainty about how much inflation there might be in the system, and if there is uncertainty about how economic relationships are between variables that are relating to the inflation process, if there are uncertainties about that, those two different kinds of uncertainties, then an approach to front load your monetary policy tightening yields a superior outcome than if you take a gradualist approach. And one channel through which this front loading can work to the advantage of achieving the inflation objective is through the exchange rate. Now, both of these exercises, both the sort of front loading and the role of the exchange rate, is something that I talked about in one of my speeches on global spillovers. And so that speech went through different strategies of the monetary policy, tightening strategies. Should you tighten quickly? Should you tighten slowly? And as I say, if the objective is price stability, which is our main objective, then a front-loaded, more aggressive strategy was the one that achieved the objective of price stability. Now, we have gone through the course of the year. As you know, the way the Bank of England works is there are 9 of us. We all vote. Majority is the decision on how to change bank rate. And so over the course of the year, sometimes we increased by 75 basis points. Sometimes we increased by 50. This most last increase was 25 basis points. So there has been a more gradual pace of increases than I would have chosen if I was the dictator, but I'm not. We are a collective. And so we are at a point where we have gotten quite a ways towards what an appropriate tightening is. Have we gotten there yet? What's a data-dependent exercise? What do I look at? Now, I gave a speech at the Lemfalusi conference at the Central Bank of Hungary about a month or so ago, where I outlined what it was that I look at in terms of the data that I look at in order to determine what the appropriate vote is. And of course, again, the Bank of England, we are all transparent in our votes. You know exactly what I voted for, right? There's no dot plot. It's just the votes. They're right there. And then we talk about why we voted when we give our speeches. And so a key element, and I mentioned it before, was the evolution of price expectations. And there has been from end of last year to the most recent survey, the so-called decision maker panel survey. This is publicly available data that I look at the distribution of price expectations for own prices for firms 1 year ahead. They also give me information about what firms think CPI is going to be 3 years ahead. There are household surveys that also give this kind of information on expectations. And a key factor for me in agreeing with also voting for the majority for a 25 basis point increase at the last meeting, an important ingredient for me was that these forward-looking measures of price expectations, particularly for firms and households, had started to moderate, which is exactly the signal to me that my monetary policy is having an effect. Now, interestingly, which I think is an interesting point, underpinning demand in the UK has actually been relatively strong. And today's retail sales, real retail sales for February, were pretty robust. And so the monetary policy can work through expectations as well as through aggregate demand. The aggregate demand channel is the one that we're all familiar with, where higher interest rates reduce consumption because mortgages are more expensive and reduce investment because cost of credit is more expensive. That's our standard channels. But we also have observed from the research, again, using the data, that monetary policy can change people's expectations for the future and for the future prices, future evolution of prices. And so that is an important ingredient, a separate channel through which monetary policy can have an effect. Now, I wrote a speech and that I gave, maybe it was about a week or so ago, I can't really quite remember, where I talked about financial conditions and the monetary policy transmission mechanism. There's our principal instrument, bank rate. That affects financial conditions, credit, mortgages, the exchange rate, equities, and those financial conditions are then absorbed into the decision-making by firms and consumers. So that's a transmission mechanism. So it's really important to look at financial conditions to gauge how much bank rate changes have actually shown up to tighten financial conditions. We started from a very loose accommodative stance on account of COVID-related, quantitative easing. So there's a lot to tighten up before we actually get to a tight 10, a tight condition. So these are the kinds of things that we continue to look at and will be extremely important going forward to our next decision in May is expectations of inflation, credit conditions, and financial conditions more generally, what's actually happening to inflation, and of course, what's actually happening to aggregate demand.
Well, who thought we'd be nostalgic for the COVID years? Thank you, Catherine. Katja, I know you've got to go. Do we have time for one more question for you? Or
well, I really have to go, but I would like to only comment on what Catherine has said, which is extremely important to be effective in lowering inflation. It's the credibility of Monetary Policy Council of the central banks. You have to remain independent and to communicate well to the public about the direction of monetary policy. Without communication, proper communication and independence of the central bank, the process will not be so successful. So this is very important message across the globe, because we see some issues with independence of the central banks and with the communications as well, which is confusing, and then we might have some other shocks that we observe now in the financial market that might be an effect of the miscommunication of the central banks. I would like to thank you all, and if there are any questions, I would be happy to answer them by email. But I really have to go, and thank you very, very much, Michael and Catherine, for having me in the panel.
Thank you for joining us today. It's been great to have you. And Catherine, I guess that leaves you and me and the questions that are out there. We do have one from the audience that I've got a couple here. And this is sort of a universal question for central bankers in this time period, where at the same time as prices are going up, wages are going up. And our questioner asks, is it fair, or should central banks take what might be considered an anti-labor stance by trying to prevent workers from catching up with inflation, because many, even though they've seen wage increases, have declining real wages?
The decisions of firms to set their prices and wages and workers to negotiate with their companies, either it's an official wage negotiation, say through a union, or more on a one-to-one basis. That is private sector. That is not our job. Our job is to look at the outcomes of those pricing decisions of firms and functionally pricing decisions of firms, because inflation comes when firms can raise prices systematically. So how wages are set, that is a private sector issue. One of the things we find very interesting when we look at wage developments and labor market developments is and wage developments. We look at wages sort of from the standpoint of sort of the underlying wage growth. That's a pretty important information. But there are two other pieces of information that we think are very important when thinking about what wage growth might be going forward. One is to consider how important bonuses are in over sort of the underlying labor cost. So last year in 2022, one-off payments, bonuses, these were very important in overall labor costs, but they are not the same as wage growth, right? So when we talk to firms, we have a network of so-called agents that are throughout the country that keep a close pulse on firms and workers and households around the country. And we go and visit those agents all the time. I've been to a whole bunch of different places. We talk to the companies, we talk to citizens and citizens panels and really get a sense of what's going on outside of London. And so we get a lot of information going forward for 2023 that suggests that bonuses are not going to be such a big deal. One-off wage payments, probably not such a big deal. So more of an underlying wage dynamic. A second piece of forward-looking information that we think is particularly important in understanding sort of wage dynamics going forward is to look at labor market entry and exit, how much labor market churn there is. If you're a U.S. person, you know this as the Bureau of Labor Statistics JOLTS data. What it is it tells us when a person changes their job and they go to a new job, what wages do they get? Now, presumably, if they change jobs and get higher wages, that ultimately will show up in the wage dynamics going forward. Last year, we saw a lot of labor market churn. We saw that the people who changed jobs really got a much higher wage. And that translated into stronger wage dynamics when we or labor cost dynamics when we put the whole puzzle together. One of the things that we look at, we have seen in our equivalent of JOLTS, is called REX. Anyway, is our labor market entry and exit data. Is there much less churn? And people who change their jobs, they still got a higher wage. I mean, that is why you change your job under most circumstances. You're going to get a higher wage, but it's not so dramatically higher than the underlying wage dynamic than kind of what we get from the agents. So that tells us something about how labor market recruitment is not quite as difficult, and the underlying wage dynamics are probably going to be closer to the expectations that the agents have given us, which is still 6%. So it's not our job, as I said. Your question was taking on an anti-labor stance. Not at all. I mean, it's not our job to get involved with having an impact on the private sector decision making. Our job is to bring inflation back to 2%.
Well, we may have time for one more question here. And journalists being journalists the world over, I have one from one of my compatriots across the seas, one of our British friends, who poses the question about banking sector stability, which is obviously in the news today. How much could recent concern over stability in the banking sector, and you guys move very fast on SVB UK, but how could that instability have an impact on the UK economy? Do you see credit conditions tightening, and will that be much of a headwind for the UK economy doing some of the work of a higher bank rate, in the same way people are talking about the Fed may not have to do as much here because we'll have tighter credit conditions?
Well, of course, monetary policy and financial stability are two separate committees at the Bank of England. We did get extensive briefings from the Financial Stability Committee on Financial Policy Committee on the question of financial stability, and we made our judgment on the increase in bank rate last Thursday based on macroeconomic conditions. So that was the fundamental discussion around the table. Now, when it comes to credit conditions, of course, credit conditions are something that we look closely at every single round. It's part of the overall macroeconomic landscape. And I have to say it's microeconomic landscape too, because all this stuff is micro data now. We know all the things about mortgages. We know all of the, I said we have a decision maker panel survey, which is of individual firms. So macroeconomic outcomes underpinned by microeconomic data. Credit conditions are a key element of that. We get, as I say, it's an aspect of every single meeting that we have. We have extensive briefings on market conditions so that we understand sort of in real time how markets are playing out with regard to the yield curve, different asset classes, spreads, the whole set. So in that context, as financial markets interpret the degree to which there is changes in funding costs, does that pass through from banks to change in funding costs to banks as they assess each other's credit risk? How does the potential credit risk of different commercial entities, non-bank entities, how does the credit risk get reflected in mortgage rates? These are all things that are absolutely on the plate when we will be looking at data and macroeconomic conditions for our May monetary policy report.
Are you anticipating a tightening that would have the same effect as a bank rate rise?
Well, I think I have to wait to see, right? I mean, we have our eyes open to what exactly is happening in terms of financial conditions. As I say, the financial conditions is a centerpiece of the monetary policy transmission mechanism. When we look at the data and we look forward, we get surveys, we get impressions, we have market intelligence people out there asking questions. So we will be getting data in real time about the financial conditions, credit conditions, and if they tighten, then that's part of the transmission of monetary policy. And we will take that into account when we make our looking at the overall landscape of macroeconomic conditions in May.
Well, I guess that takes us kind of to the end of our time allotted here. So I'd like to thank Catherine Mann for joining us today, and also for Katja joining us earlier, and unfortunately she had to leave. And now, David, I'm going to turn it back over to you. You're looking very casual down there. I'm guessing the weather is better than where Catherine and I are.
Mike, before we let Catherine go, Kathy, do you have a few minutes left?
Just a couple.
Just a couple. So
Yeah.
just one question to continue the theme that we've been talking about is payments, trade credits in a multipolar world. We now have a growing MIR system, Russian-based. We have the system that we're all accustomed to that's US dollar based. And in the latest count has 9 countries in MIR, and that means, and 2 of them are India and Indonesia, which is a bridging mechanism. So really 2 questions. This is new. We didn't have this system for a while. Maybe I don't recall ever having it, but who knows? I haven't looked at currency histories over 400 or 500 years, but certainly not in the electronic age. Can you say a word about the trade, credit, financing elements that were in a multipolar world, one, and are there any spillover effects to the central bankers' decision-making, which tends to be locally focused country-centric, if you will? So two things.
So the first question, David, is about plumbing. When there are multiple pipes or when there's different products going through the same pipe, how does that work as well? So I think there's some questions that we'll have to look at, and not me, not the Bank of England. This is not part of monetary policy, but as researchers, I spend some of my time anyway being a researcher, understanding multiple means of exchange, multiple invoicing, because that's kind of the starting point. For different currencies in the payments mechanisms. How efficient that is, we will have to see. And we also have to see how well the different payments mechanisms talk to each other. And I think we don't know that yet, frankly. The second question, which is, do we pay attention to these sort of global things? We absolutely do take attention to the macroeconomic consequences of things like multipolarity, the implications for efficiency in foreign exchange markets, or efficiency in cross-border payments mechanisms. To the extent that these things create sand in the wheels and make it more costly to engage in both financial transactions and the real transactions that are financed by by trade credits and so forth, then there are macroeconomic consequences of that. And because he's both the global financial market, global trade, in terms of globalization, both trade and finance, for a small open economy, the UK it's not the United States. It's not China. It's not Europe. It's a small country. It has its own currency. And so the global spillovers are extremely important. And we do pay attention to a lot of them.
Thank you. Well, final question for Mike McKee, if I can get 1 minute of Mike. It's a rare opportunity to reverse roles and ask a question of the journalist. Mike, we just witnessed a GSIB bank fail. I don't remember the last time we had a GSIB bank fail, maybe in the financial crisis. Mm-hmm. There was no reporting that I saw of the fact that Credit Suisse was a GSIB bank, and no reporting about counterparty risk, the derivative books, the notional backing of derivatives, which are being marked hourly. It never made the story, never made the headline that I saw. Maybe it did. I may have missed it. Is this something, as a journalist, that you watch the entire central banking world from your perch in Bloomberg in New York? Is this something that's off the radar screen, or too complex, or should we not worry about it?
Well, David, I work at Bloomberg, where these are the kinds of things that we do focus on as journalists. I'm watching central banks more from a policy standpoint than from a supervisory standpoint. It's sort of like the division that Catherine has at the Bank of England. But the Credit Suisse situation, much like SVB, you would probably call somewhat idiosyncratic, in the sense that it was a bank that had a lot of problems in a lot of areas for a long time. But this wasn't like the financial crisis, because it wasn't counterparty problems. It wasn't an inability to pay. The bank was well capitalized according to the regulators. So it kind of didn't fall into the same bucket as we saw when we were chasing all of the banks and non-financial institutions back in 2008 and 2009. And I think people are not as concerned about, we're not as concerned about whether there would be a counterparty problem. I know the Swiss National Bank was very aware, because Credit Suisse had essentially a living will of what was there and what problems they had. And that's one of the great differences between now and the great financial crisis is that the regulators are much more aware of what the issues will be if one of them gets into crisis. I don't think we've really had a GSIB bank, David, to fail because the concept came along later. And Credit Suisse in the U.S. doesn't qualify. Its banking arm is not big enough, but as a global systemically important bank, it is definitely on the list.
Well, thank you, Mike. I think Catherine probably just dropped off. I don't know, but we want to thank her publicly, and Kasia too. And thanks for this panel, and safe journey, Mike. We'll see you soon.
Great.
And I'll wave goodbye, and we'll switch electronically, Mike, to our next session. Thank you. We're about to bring in Joe Mason. And there he is. Where are you, Joe? You're on mute.
I'm on the western slope of Colorado, and my mic was muted.
Western slope of Colorado. And what's the weather like on the western slope of Colorado today?
It won't stop snowing. This winter is not ending.
Snow in Sarasota is a 4-letter word, you know. All right, we have a real final message. Joe Mason and I know each other for a long time. We have traveled in various parts of the world together. His expertise in banking, in the system, in the response mechanism of regulators, some of whom he has advised in his career, and he has an articulate view about the SVB crisis, and some may have seen his piece recently in the Wall Street Journal. So without further ado, Joe, why don't we have you give us your thoughts on the banking crisis, what happened, what you think is coming, and then maybe we can do a little Q&A before we expire in our time.
Thanks, David. Just setting myself a timer here so I know where I stand. I think first it's important to point out that this is the issues that we've seen in banks recently are a combination of monetary policy and supervision. And that really matters a lot from where I stand. My background is OCC, Office of the Comptroller of the Currency, the Sup and Reg side. I was a senior financial economist there, where I started studying securitization and learning from examiners. But Sup and Reg at the Fed or at the OCC is very different than what economists do on the research side of the Fed. The research side of the Fed does not get through that door. And literally there's a door. I remember visiting a friend of mine at the Philly Fed who had been at the OCC with. The OCC was one building, one lock. It didn't matter. But at the Fed, we went over to his office, and he went through another layer of security beyond just the Fed security at the front door, which allows you access to the monetary economists. Sup and Reg is always behind closed doors. We have inside information. We have proprietary information on our desks. We have a clean desk policy, et cetera, et cetera. But you see things differently. And I'm just going to say it. Sup and Reg is viewed as the poor stepchild in economics. If you go to work in a Sup and Reg area as a PhD economist, people are like, yeah, whatever. Whereas if you're on that outside function, it's viewed as very, very cool. The outside function isn't as much relevant here, though. And the press has cited a lot of Fed economists, if you will, in that outside function on Sup and Reg issues. And they're just not informed. this is an issue of an individual bank's solvency, at least Silicon Valley is. And in fact, all the bank failures that we've seen are fundamentally rooted in solvency issues, whether or not a run is attached to those or not. But those solvency issues form a commonality across U.S. banks, in fact, across global banks, that has to do with a rebalancing in the U.S. economy. You have to remember we're coming off of COVID still, and now we're in this high interest rate policy. So we have kind of you can think of it as short and long-term effects, fast and slow-moving effects affecting bank solvency as they restructure portfolios to operate in this environment. And this makes sense. So when you look at Silicon Valley Bank, you're talking about tech VC. What happened in tech? Well, a lot more people bought Zoom subscriptions. A lot more people bought tablets, smartphones, computers during COVID to work remotely. Well, that booms over. Tech didn't sell a lot of new products during COVID. They just sold more of their old products. But that plays over, and we see that in the tech layoffs throughout the sector, and that principally affects the San Francisco Bay Area, Silicon Valley, and banks like Silicon Valley Bank who are dealing with tech VC. What we're also seeing in First Republic and its ilk are commercial real estate exposures. Those have kind of held on, but David, my firm is looking at our commercial real estate. I'm with a consulting firm out of Dallas, the BVA Group. We've got office space in Plano, and we're kind of scratching our heads as our lease is coming up for renewal, saying, do we need this space in this post-COVID environment? What are we going to do? It's a little expensive. It's not really where we want to be. That decision and that consideration is being shared among almost every company in the U.S. Looking to economize on our lease payments. And that is affecting CRE borrowers, and that is affecting, therefore, CRE lenders like First Republic. So, this is fundamentally a slow-moving solvency issue. This is an issue that was present pre-COVID, so it shouldn't come as too much of a surprise to note that this issue was accelerated post-COVID now, and this is part of what we're seeing in bank portfolios. Again, First Republic's in the Bay Area. We have kind of the same thing. These effects shouldn't come as a surprise, though they're manifesting more quickly, in part because of rate policy. High interest rates create dislocations. They're designed to create dislocations. I'm trained in monetary theory. That's my core interest, and how the micro of soup and reg feeds through to monetary theory. This is what we're trying to do. But I do find it interesting that many of the regulators are caught unaware today. I'm finishing a paper on the doubling of reserve requirements after the Great Depression in 1936 and 1937, which forms our basis for our fear of raising rates too fast. We've believed for decades, since days of Friedman and Schwartz, that is what caused the recession of 1937. We find it's not. But the relevant point here is, before the Fed did anything with that reserve requirement increase, they performed an extensive study of U.S. banks and found that only about 25 banks out there were unable to meet the demands of those reserve increases out of their existing resources. I would have hoped that the Fed had performed a similar study before embarking upon a very fast program and dramatic program of rate increases, but it doesn't seem like they have. For some reason, we're surprised. Part of the Silicon Valley Bank failure was due to changes in the value of their RMBS portfolio. Now, this is largely agency RMBS, but RMBS are important and were important during the financial crisis, and still very important to every fixed income investor's portfolio because they contain negative convexity. We're raising rates here. The private label you're going to get lower voluntary prepays, but higher defaults. And of course, agency, you're going to get just involuntary and voluntary prepays. So this is changing the way we mark portfolios. It's kind of mucking things up a bit. But all this is coming on, I see it might want me to wrap up here. But this is coming upon SEC policy that's really pushing back against funds for their marks and for using what the SEC is calling odd lot marks and mismarking. Mark-to-market account, we expect more of mark-to-market accounting than it can deliver, whether that's on Silicon Valley Bank's held-to-maturity portfolio or in many small funds across the nation. And while the SEC is penalizing these small funds, they're not really penalizing significantly the mark providers for providing the marks that the SEC is saying are wrong and shouldn't be used by the small fund providers. If in the news about 6 weeks ago, the SEC did fine Bloomberg $5 million for providing what they considered inappropriate marks on private label RMBS. I found that a bit outsized because I was involved in regulatory defense for a small fund, much, much smaller than Bloomberg, that was also fined $5 million. That $5 million meant a lot more to that small fund than it meant to Bloomberg. But we have to get our grips around mark to market. We have to get our grips around this reallocation and this new normal that the banking industry and the economy faces today.
Joe, some of the folks who will see the video of our discussion, because the distribution of the edited version will reach thousands of people. Negative convexity is a very technical term for many of them. Many don't understand marking, let alone high-frequency marking and counterparty risk. We do, because we're in the business, but most of them don't. The experience, though, is they see a bank fail. They worry about an insured deposit. They are moving deposit monies to a government money market fund because they think it's safer. They don't know what to do. So we have a strategic change in behavior going on throughout the United States and other places in the world. We talk about how that has a tightening impact. It shrinks the credit multiplier. It changes behaviors in ways in which the system's credit mechanism is not as easily functional. Yet that is a very hard thing to measure until after the fact. How do you deal with that? You advise. How do you deal with this issue of a tightening credit structure in the United States because of the events that have taken place in the last few weeks?
The degree of tightening arising from recent events is less than we would have seen had those events happened 2 decades ago or 3 decades ago. Deposits are far less important to intermediation today than securitization. And that's true of business loans as well as consumer loans. In addition, one thing we have to struggle with in what we call this credit channel of monetary policy transmission is the degree to which deposits leave the system. It's important to contrast the system with the health of an individual bank. As long as the system's healthy, we're good. The money that leaves individual banks, and this was honestly true in the Great Depression runs as well, In the Great Depression, money would leave the banks. People would leave the teller window with their cash, and they would go to the postal savings window typically. We offered postal savings accounts back then. They would deposit the money there and think, okay, I'm safe. They didn't realize the postal savings system could do two things with the money. They could invest in treasuries and they could invest in other banks. So the money didn't leave the system. It was redeposited in other banks. We are seeing that today. We're seeing redeposits into other banks, particularly large banks. So the money's not leaving the system. Then, of course, those large banks are reinvesting in things like First Republic to help it stay alive. So far, the system is actually working pretty well. Again, fingers crossed. We're going to hope that continues. But we're still going to see this dislocation roll through the economy. And that's where the Credit Suisses come in, right? Credit Suisse was facing troubles for a long, long time before this UBS transaction. We're going to see what's happening at Deutsche Bank today. The large banks are not immune, but are they going to face a run? I don't know. I'm going to actually hold the answer to that. I'm not going to say no, but I'm not going to say yes either.
We haven't seen yet the bank size fail with a run, and the size of the bank was, say, under 50 billion. So you've discussed the change in the stress tests from 2018 and why the stress tests were flawed because they didn't consider a rapid rise in rates. And you addressed that articulately. What happens when an $8 billion bank, big enough to be a big community bank, small enough not to be a regional, and there's no position in the law unless the FDIC, the Fed, with the concurrence of Treasury, say $8 billion is a systemic risk. What happens? Is there another shoe to fall here, so to speak?
In my opinion, community banks are a different business. I kind of came up in this industry through community banks, and community banks are undertaking very high touch lending to local communities. They're not as affected by straight interest rate risk, not as affected. Doesn't mean they're unaffected. One has to ask the question of where does the cost outweigh the benefit with regard to stress tests? At what size level, or better yet, at what level of focus of a bank? And I say it that way because you can still have very small, as you said, $8 billion banks that are extremely financially savvy, and they're not doing community lending. I remember one in New Orleans, Louisiana, very small bank. It was primarily invested in trust preferred securities. It was kind of it was almost a trust fund, which is a very technical financial instrument, but they weren't doing lending and deposits like we typically think of. Small banks do weird things, in other words, and those weird things aren't likely to be captured adequately in stress test models, which are very costly to run, very costly for the bank to set up. And so it might not make sense to extend stress tests to them. But that's where the examination function, which is still a pillar of Basel, really makes a difference. Examiners have to get in there, look at it, and see what the heck is going on, but not rely so much on these mathematical models. Stress tests, in my opinion, have been flawed since they were initially implemented. We implemented them initially in the SCAP program, and I came across an op-ed I wrote back then saying, well, this is the way forward for regulation. Everybody said, no way. And of course, now it's implemented as part of regulation. But when they implement it as part of regulation, they didn't really take kind of like a Great Depression scenario. And I talk about the Great Depression, but that was a watershed in banking. And we look at that in credit risk as some kind of like a worst case realistic thing. It's something we've actually seen in the economy. Would we see it repeat itself exactly? No. But can we reasonably take parameters from that and say, okay, our stuff should be able to deal with this? And that's the feeling. We should be able to do that. And on a stress test, well, you're supposed to really stress the bank, stress the performance of the loans, stress the economy. But we haven't done that. We kind of take this middle ground scenario of like, well, it could get a little bit bad. What does that mean? Without any grounding of the scenario in the level of stress that we could reasonably expect to see. What are we really doing with these stress tests anyway? It's my opinion that we're not going far enough with the scenarios. Do we have the size cutoff exactly correct? I would say no, and I'm not sure there is one static size cutoff we want. Should we have some discretion so that if you're just under the size cutoff, can examiners say, yeah, I'd really like to see a stress test? That's probably the way to go. We need to balance rules with discretion and make sure that examiners are empowered to make decisions that sometimes are a little outside the rules.
Let me ask two more questions before we break it off, if you've got another couple of minutes. Are we headed for a national deposit insurance scheme in the United States? Maybe multi-tiered, maybe multi-tiered fees, maybe risk-based FDIC fees, some mechanism. But is this shock bringing us to a system in which deposits of all types, all sizes, will be insured by a federal authority?
I sigh because I think we are, but it's important for me to say I think we've already been there for quite some time. I was part of an industry group when I was an OCC economist, and in those industry group meetings in the 1990s, a large part of the discussion surrounded how the FDIC does typically insure uninsured deposits. And the reality is that in the moment of a bank failure, on that Friday when they're shutting down the bank, and over that weekend when they're working hard to sell the bank and also gather whatever evidence they need if there's fraud or records or what have you, it's not a lot of time to figure out who's covered and who's not covered. Even on the individual side, there's always been discussion. If I have 3 accounts at the bank and the sum of those 3 accounts exceeds the deposit insurance limit, how are we going to link all my 3 accounts and know that I'm me and one's not my wife, but is me, and deny me coverage on some amount? No, we're not going to do that over the weekend. No, we're just going to cover everybody. We're going to move on. That's how things have typically worked. And that shouldn't come as a surprise because deposit insurance assessments are made on the total liabilities of the bank, not just on insured deposits. There's just practicalities with what we can do on the ground that have led us to this moment. There are other considerations that come into play that we probably don't have time for here, but which I'm going to talk about next week. And I don't have them completely nailed down, and I don't have the language completely nailed down, but as Ms. Mann said on the last session, a lot of these issues have to do with the plumbing, how things move through financial markets and institutions and across financial markets and institutions. And there are, again, just like in the global financial crisis, major plumbing issues that need to be addressed.
Thank you for the time and participation with us today. I hope we get to visit in Colorado this summer. Safe journey. You certainly will be very busy. That's for sure. There's a lot more ahead of us. It would appear that this period of transition in the banking sector is not over. Well, thank you, Joe. We're going to conclude today's session. We resume on April 20th in person in this auditorium. Governor Christopher Waller. The conversation on April 20th will involve payments and cryptocurrencies, central bank digital currencies, other market-related pieces. And the next day, we will have a focus on China, Asia. We will have a military component with General Gray, who has organized that. We'll talk about geopolitical risk and some China economics. And that's April 20th and 21st, both in person and virtual. The auditorium will be open. Joe, if you're in Sarasota and you want to escape the snow, you are always welcome. And we'll conclude today. Thanks for being with us, Joe.
Thank you, David, and thanks to everyone else.
That's it for today. Thank you.